Good morning, everyone. I'm Richard Williams. I'm property analyst here at Quoted Data. Welcome to Quoted Data's Property Summer Conference. This is the third in our series of weekly webinars. We've been running these webinars every Wednesday morning in July, and our final one is next week, which is for professional investors only. For more details and to register for that one, please visit our events page on our website, QuotedData.com. Before we get started, I just want to thank our sponsors again, who are Schroders, Hibernia REIT, the London Investor Show, Master Investor and Mello. And today we have 4 property companies and fund managers presenting. We're going to kick off with Matt Howard, Deputy Fund Manager at BMO Commercial Property Trust. Then we have Jason Bagley, Fund Manager at Standard Life Investments Property Income. Thomas Edwards Moss, who is the Chief Financial Officer at Hibernia REIT. And we will wrap things up with Bronwyn Corbett, Chief Executive of Grit Real Estate. They will each give us an update on their funds and provide some insights into the property sector and how COVID-19 has affected it and the long-term implications on the property sector. A bit of housekeeping before we get started. Each panelist will present for about 25 minutes and there will be a Q&A session at the end of their presentation. If you want to ask a question of one of the panelists, please use the Q&A function in Zoom during their presentation, or if you're dialing in, you can email me on rw@martinandco.com and I'll put your questions to them at the end of their presentations. Before we get started on the presentations, I just wanted to share a couple of slides with you that reveal the polarisation that is developed in the property sector during COVID-19. I've shown these slides in previous weeks, so excuse me if you've seen them before, but it just shows the extent of the pandemic and its impact on the shares of listed property companies. So as you can see here, in around early March, when the pandemic really sort of took grip in the UK, share prices fell off a cliff, and although they started to recover, that still hasn't come back yet. Reduced rent collection figures and uncertainty over the future has really shaken the confidence in real estate. This slide shows the contrasting fortunes of the retail and logistics sectors. Of course, the retail and leisure sectors have been the biggest hit, and you can see the impact there on the retail-focused property companies on the grey line. Rent collection rates have been well below normal, well below 50% in most cases, and a host of retailers are going into administration, which hasn't helped. The pandemic has accelerated real estate trends, with the pace of the shift to online retailing increasing. That can be seen in the logistics sector, which is the black line. The positive sentiment in that sector is really reflected in the share prices of the logistics-focused property companies. As I said, the polarisation has really started to develop in the property sector, as can be seen here. These are the rating changes in the second quarter. And as you can see, logistics companies have sort of dominated and really seen the ratings increase. Sector specialists such as self-storage have also done well, but not in this list, but have also sort of performed well during the pandemic, has been the healthcare-focused property companies. This slide shows the generalist property companies that have diverse portfolios have really suffered. Diversification of income should normally be a positive for real estate, but investors seem to be favouring the specialist REITs at the moment. It means that several companies with diversified portfolios are trading on huge and probably unmerited discounts at the moment. What is interesting is that despite several of these generalist companies having significant weightings to the industrial and logistics sector, some with around 50% of their assets in logistics, they've seen their ratings deteriorate. We have a couple of diversified funds presenting today, as well as property companies focused on Ireland and Pan-African property company. So I'm expecting some really fascinating insights. So to kick us off, we have BMO Commercial Property Trust Deputy Fund Manager Matt Howard, who we have on the line. I will just unmute him. Good morning, Matt.
Morning, Richard. Good morning, everyone.
How you doing?
Very well, thank you. Very well.
Good. I think on mine, your volume's a bit low on mine.
Oh, really?
Can you maybe turn it up?
I can play around. How's that? Is that better? Is that better, Richard?
Not really.
How's that?
Let me see if it's nothing I can do. I can hear you. It's just a bit low. So maybe if we just crack on anyway. I will, as I have in previous weeks, I'll control the slides. So just give me a nod when you want me to.
Fine. How's that volume?
Still a bit low, but. Do you
want me to change my headset just quickly?
Yeah, if you've got something else, yeah.
All right.
Yeah, we've got a couple of minutes.
Good. 2 seconds. How's that? Any better? About the same.
Yeah, that's better. Okay. Good. All right. So I'll hand over to you, Matt.
All right. Thank you, Richard. As I say, good morning, everyone. I'm Matthew Howard. I'm a director of property funds at BMO Real Estate Partners. I fund manage one of our SEG accounts and deputise on the BMO Commercial Property Trust. And as Richard says, today I'll focus mainly about talking about the trust. I'll spend a little bit of time talking about the market and really try and put our stance on things. So I appreciate you've probably had a lot of market conversations of late. So we'll do that and also spend a few moments thinking about how we see the world going forward. So Richard, if you don't mind moving on a few slides to a headline slide, I think it's number 5. Couple more. There we go. So some of you may have seen this before. It's a slide that the House has released a few times in the last couple of months. And I suppose the difference here is this summarises a lot of the positives that we're starting to see now. Now, obviously, we're not out of the woods. We're still in a form of lockdown of sorts, and we're certainly not back to normal. But we are in a stage of the market where we're seeing life kick in again. If you went back to the depths of March and April, it was certainly unknown in terms of where we were heading. And some of these headlines really summarise what's started to kick in now. So, for example, material uncertainty clause has been lifted for supermarkets, industrials, and central London offices. Transactions are happening as well. We have seen some specific assets in certain sectors be marketed, have the legal due diligence, and also complete all within the lockdown period. And amazingly, UK transaction volumes are only slightly down, about 16% down on last year for the first half of the year. So if you compare half one of 2019 with this year, we're only down 15%, and we're above in terms of long-term trends. And that's because of how strong Q1 was, and that market was going great guns before the inevitable happened. Richard, if you don't mind moving on to the next slide. And really here, I won't linger on this, but this summarises what was happening in commercial real estate over the last couple of years. So pressures at an all property level in capital values we were seeing for the last 2 years, and that was certainly driven by the retail sector. There was a major polarisation. Now, there was also a lot of uncertainty last year in terms of the Brexit deal and how that was going to look, and also the general election. But once we had passed that, as I say, the market had kicked in, and we were actually expecting to see some kind of uptick in valuations overall in Q1 of this year. But obviously, things changed slightly. Next slide, please. And this really summarises what I said a second ago in terms of the dislocation, which is a very popular word in property at the moment, or polarisation between total returns on the retail sectors on the left-hand side compared to those in the other sectors, which is a very different story. And I'll elaborate on that as we go through the presentation. Okay. So this show, you've probably seen something similar to this recently, and it really shows the premium or arbitrage between all property income returns and the perceived risk-free rate of 10-year gilts. Now that premium typically sits between 250 to 300 basis points. It's never really stays in a consistent level. It fluctuates quite a lot, but that's the average gap. So an arbitrage of around 500 basis points is quite something, and there's a reason why UK commercial property is still very attractive to many investors. Okay, and this is my favorite slide of the market slides, and you could find me boring people at dinner parties about it. And it's really about the growth of online retail because it has so many connotations for the property market. Now, if you rewind back about 2 years to 2018, you'll recall there was a spike of retailer CVAs and administration in the middle of 2018. Now, if you didn't know better, you would be forgiven in thinking that suddenly online had taken off in a big way, that was the major crunch on physical property sales. But it's not quite as simple a story as that. The graph on the left-hand side really shows that online sales has been a steady but pretty consistent eating away at all UK property sales. And if you go back a little bit further to 2008, online accounted for about 2% of all UK sales. As at the end of 2019, it was about 19%. Now, as Richard touched upon only a few moments ago, there's been an acceleration in online sales in recent months and weeks. And the reason why there's consistent growth, and it's a slow chipping away overall, it's not because of the technology, but it's because of the culture. It's culture which holds back change. And if you took, say, the average 25-year-old in the Western world, they probably spend a huge portion of their disposable income online. You take the baby boomer generation and ask the same question, you'll probably find a bit more of a mixed bag. But that would have changed significantly in the last couple of months. And those people that didn't have accounts with the grocers, with Amazon, and perhaps fashion retailers as well, they'll all have accounts with these retailers online, and these are habits that will last a lifetime. So what does this mean for real estate? Well, I think if you look on the spin side, the really interesting element from my perspective is that you have actually seen during lockdown the resilience and the propensity for physical shopping. Obviously, we had to move online, but when the stores started opening, such as the queues that you were seeing at B&Q, the DIY chains, IKEA, some of the fashion chains, when they started opening, it showed that there was a propensity to shop physically. And the point being is that the reason why the narrative has all been very negative to physical retail of late, and will continue to be for a while, is because things are shifting, and retailers are struggling, a lot of them are struggling to get up to speed with their omni-channel offer between physical and online retail. But there will be an equilibrium point where the two of them sit more in harmony, and it will not stay static for long. But I think that maybe a good thing to come out of the acceleration of a trend, we've probably moved forward about 5 years in the last few months, is that we're a lot closer to getting to that equilibrium point. There will be casualties on the way. We're not through the woods yet, but we are closer to perhaps what the future looks like. Okay. Okay, so digging a bit deeper on the BMO Commercial Property Trust, many of you on the call will be familiar, some won't, but it's a balanced UK commercial property REIT. The NAV of the portfolio as at the end of Q1 was just shy of 1.3 billion. We do have updated valuation that will be announced in the NAV announcement, which will be out in a couple of weeks' time. We're a conservatively managed business. We have net gearing of about 22%. We're also running at quite a significant discount to NAV. I mean, you can see on the slide, it was about 40% at the end of March. It's about minus 57 as of close of business yesterday. And again, I'll probably explain a bit as why we think that's the case to a certain extent. We have quite a low void rate at the moment. It's only 3.2%, despite some of the headwinds we faced, particularly with our retail assets. And we have a healthy average unexpired term of 6.3 years, which is pretty comparable to most balanced funds. We're also, obviously, as I say, a REIT, and we converted to a UK REIT status a little over a year ago in June 2019. So it's probably worth spending just a couple of seconds to explain where we are with our dividend. Like a lot of our peers who have either cut or suspended the dividend, we suspended back in April. We're one of only a couple of REITs that pay on a monthly basis, so we had to make that decision earlier than most. It was really based on the uncertainties, obviously, around the Q2 rent collection, but also the Q3 rent collection, where if you rewind back to April, 2 months in the future seemed like a long time away, and really didn't know what the landscape looked like at that point. But you would have seen, and I'll talk about in a bit more detail, rent collection stats have been generally more healthy than originally feared. So our board will be discussing when to reinstate the dividend at some point in future. Can't say too much more than that, but obviously it's all based on income. So if we move forward a couple of slides, please, Richard, to total returns. One more. Thank you. So this summarizes our performance in recent years. As you can see, our performance has been relatively muted in the short term, mainly down to a few specific retail assets. But a longer term performance, certainly over 7 and 10 years, is still looking pretty healthy against the benchmark. And that's very important to us, because ultimately we are long-term investors. Okay. This is a handy slide, visual representation of where we own our assets. And you can see that we certainly have a bias towards London and the Southeast, and we generally pick key regional destinations across the UK. Okay. And these are the sector and regional breakdowns. I won't go through all of this data, but to repeat the point I made a second ago, we have around 60% weighting to London and the Southeast, which compares to the benchmark, I think it's around 45%. In terms of segment split, we're a balanced fund, and we reflect the MSCI benchmark fairly well. Our retail holdings are about par. We're slightly overweight in offices and slightly under on industrial. And we have a benchmark matching exposure to the alternative sectors around 10%. And that includes a student housing block, some residential, which is about 4% of the fund, which is part of the St Christopher's Place estate, and cinema and a gym in Wimbledon. Okay. Right, so the slide you've all been waiting for, which is the rent collection. I have to say this is slightly out of date. This was from our AGM a couple of weeks ago. And as I mentioned, we've got the NAV announcement coming up in a week or two, which will provide an update. And for obvious reasons, I can't go into that detail at this stage. But at the point of the end of June, we were 78% of all rent collections for Q2, which was broadly on par with a lot of balanced funds at that stage. Of that residual 21%, about 5% of that were already agreed deferrals. Another 5% were rent-free that we'd offered mainly on our retail or food and beverage tenants. And there was about 10% of agreements that were still outstanding. So where we were still in discussions, we just put that as outstanding. And if you just move on to the slide, Richard, that summarises where we were per sector. So industrial offices, pretty healthy, north of 90%. Retail warehouses, not too bad either, but very much St Christopher's Place. And I think it's worth elaborating on why the numbers are quite so low at St Christopher's Place. So most of you will probably know it, or at least have passed through it unknowingly. This is a managed estate just north of Bond Street Station in central London. It's considered the main food and beverage destination for that part of Oxford Street. It's a mixed-use scheme. As I said a second ago, we have residential there, offices, a lot of boutique retailers, a couple of units on Oxford Street itself, and mainly food and beverage operators within the estate. And where we got to towards the end of Q2, and obviously with the food and beverage operators, they're the ones that need the most help at the moment, putting it frankly. And we realised that the landscape was changing quite quickly, certainly as we got to the latter part of Q2. You know, the world was opening up again, nurseries and schools were opening, and at some point in a few weeks, restaurants and retail would be as well, which we've seen over the last couple of weeks. So we made a conscious decision to hold fire on a lot of our agreements for the majority of tenants, and really wait until the landscape was a lot clearer, which we think it is now, and then agree the concessions for Q2 and Q3 together around this time. And that's something that the asset managers for the estate are very much going through at the moment. So we're now looking to lock down a lot of those agreements with the tenants. And we thought that was important because we'd know what the tenant really needed in terms of support, and just finding the right biting point, because obviously, you know, as landlords, we needed to be flexible at this time. So we think that's best for both parties. If we skip on from here, so this just goes back into the bit more structure in terms of the fund itself. They're the top 10 holdings, mix of retail and offices. There, you may notice it seems like there's an absence of industrial, basically because if you had a single let logistics unit, it would have to be gargantuan in lot size to be around £50 million. So the average lot size of that sector is a bit smaller, but it still makes up a significant portion of the portfolio. Okay, these are our top 10 tenants in terms of rent collected. Generally, the covenant risk is pretty low, albeit this is a bit out of date because this was judged on pre-COVID times. Most of these businesses are quite resilient. I'll mention Virgin Atlantic in a moment, and we're certainly diversified in terms of our occupational base. Okay. And again, touching upon our void profile, really this just demonstrates that the void is spread across the fund, so it's pretty diversified, and we've got a few. We've still got quite a lot of initiatives in hand, despite the last few months, to mitigate those risks. Okay, so digging in a bit deeper, I'll come on to St Christopher's in a moment. The other managed estates that we own is the Broadway in Wimbledon. So this is a mixed-use estate, mainly with national retailers. We have an Odeon cinema, a Nuffield gym, a Morrison supermarket, and many food and beverage operators as well. Now, obviously, it's been a relatively tough time for this asset, but it's in a fantastic location, very affluent London suburb. The site is bang opposite the Wimbledon British Rail Station and the Tube, and also we have a longer-term mixed-use development play there, which we're quite excited about, which is for well, a few years down the line, but has massive potential all the same. And as I mentioned, we have a student housing block. It's let directly to the University of Winchester, so we don't take on the direct letting risk. The tenant has paid their rents in full, and as a university, they don't rely on overseas students in particular for their subscriptions. So therefore, they're likely to be relatively resilient in riding a fall of overseas numbers of students this year. And just to cap off, this is a bit more detail of St Christopher's Place. There's a map in the corner, so you can see where it is if you weren't aware. This is what it looks like in normal times. And obviously it's been a pretty difficult period for the asset of late. You know, there's been fewer workers in central London, fewer tourists, fewer people using the tube. But the life started to kick in. Most of the operators and retailers are now open, and they're generally opening daily on a kind of conveyor belt. And the footfall is around 30% at the moment, compared to what it was this time last year. It might seem it's still pretty low, but it's on a steady upward trajectory. If you only go back a couple of weeks, it's around 10%, and it's probably people just walking through as a cut through. So life's starting to kick in. So we're confident it will be a relatively positive quarter for the asset. Okay, so looking a bit closer at our retail warehouse assets, the two on the left, Solihull and Newbury, these really have been the main drivers of some of our underperformance in recent years, despite having a fair bit of letting success. But if we move to the next slide, I'll go into that in a bit more detail. So on the left-hand side, you can see the tenants that we have lost or have gone into administration and CVA. Again, I mentioned a few moments ago, 2018, when there was a spike of CVAs, and we had ours on Newbury Retail Park all around that same time. So in the middle of the year, Mothercare, Homebase, and New Look all entered CVA. Poundwells went into administration, and then we've had a pretty good run since then. It is a relatively strong tenant lineup, albeit not totally immune, but we've had a good run until Pound Stretcher went to a CVA a few weeks ago. So what have we done about that? Well, the former Mothercare units, we've let the majority of this to Dykeman Shoes on a 10-year lease at pretty much the same passing rents that we were getting from Mothercare. The residual of the former Mothercare unit is now under offer and has stayed under offer despite lockdown. We re-let the former Poundworld store almost immediately to Hobbycraft, who are up and trading on a 10-year lease, and again paying similar rents to Poundworld. And probably the biggest news was when Homebase left. They were in an amber category CVA, so we actually chose for them to leave as part of our as their break clause as part of the CVA agreement, and we managed to sign up a 25-year lease to Lidl. Now we've just handed over that unit. They're currently fitting out. We also built over the former garden centre, so it's a brand new store there. And we had a similar story at Sears Retail Park. Not as big in terms of tenant churn, but we did lose Homebase. That was quite a big store, paying just over £1 million a year. And we've signed an agreement for lease with Marks and Spencer's for a general merchandise store. That is a drop and rebuild of the unit. So we're currently in works there and aim to hand that unit over to them later in the year. But I think the reason why, despite all this success, hasn't quite kicked into performance is because it's come at a cost. There's been a significant capex required in order to bring these tenants in, and obviously we have to absorb the void periods and the rent-free periods. Capitalisation yields by the valuers on prime retail warehouse estates has moved out, and it'll probably never come back to quite where it was before. So we've kind of taken it from all angles there. But with these anchor tenants, if you will, the halo effect of a Lidl and an M&S, it really helps kind of set up that park long term. It attracts other tenants to the parks, and once those rents kick in, well, going forward from now, really, we hope that will help drive performance and stabilise those assets. Okay, I haven't spent too long talking about industrial today. It's probably because it's all behaving itself. Tenants are paying the rents, and it's all doing very nicely. We are in discussions with a number of our tenants about re-gearing some leases, so hopefully we'll have some news to report on that fairly soon. We did forward commit to a new development on Estuary Business Park just outside Liverpool, and that's currently in marketing. And this slide just summarises some more of our activity. We have a logistics unit in Durft Estate, which is in Daventry, just off the M1. That was let to Mothercare, who are obviously now in administration. But we have the global company guarantee, so they'll continue paying their rent, albeit they've sublet to Clipper Logistics, who are servicing a short-term NHS contract. And I think that demonstrates the popularity and resilience of those schemes. And the bottom icon there, we sold a site in 2 phases to Persimmon Homes. Sold the first site last year for 6 million, and the second site completes should be next week for 5.5. So a good win for the fund there. And looking a bit closer at our offices, Cassini House in London, probably the largest in lot size in the fund. This was a major refurbishment that we completed a couple of years ago, and we recently let the final vacant floor, the top floor, to Mitsui Fudosan, and we achieved a record rent for the building, about £106 per square foot. So that's nice and fully let. So it's a good story. And also we own a building just outside of Edinburgh Airport on the estate, and that was formerly occupied by HSBC, and we managed to secure Diageo on a 15-year lease to take the entire building. We carried out a refurbishment for them. So Virgin Atlantic, you would have seen in the press, there's been quite a lot written about them recently, and obviously they're in a sector and they are a business which has been impacted heavily by COVID-19. You may have also seen recently they have secured now a private sector funded rescue package, 1.2 billion, and we have agreed a relatively conservative rent concession with them, which we can report on when that's fully signed. But hopefully that rescue package will stabilise that business and they can start operating again and getting back to some form of normal over the next 12 to 18 months. I think I've discussed everything on this slide, so we can skip again. And ESG, I can't spend a half an hour talking about the fund without discussing a little bit about our ESG credentials. The icon in the bottom left is our annual ESG report. It's our 3rd annual report. It gets released with our annual report and accounts, and it takes you through our RPI, responsible property investment strategy and priorities, what our targets are, how we've performed against those targets, where the risks are and how we're mitigating those, and obviously the consumption data and how we're trying to reduce that. And it's written in accordance with the European Public Real Estate Association's reporting standards, and very pleased to say we got a gold award in 2019 for our sustainability best practice recommendations for our disclosure for the data that we disclose and the reporting standards. So I think that's quite important for us, because really it's all about data and transparency with ESG. That's kind of fundamental. That's a bedrock to a strong ESG agenda. Okay, if we skip on. So yeah, so looking forward, again, as I said at the top of the presentation, I'm sure you've had a lot of presentations recently and giving a view on how the world looks going forward. Obviously, we are heading towards a recession. GDP has taken a huge hit, but there will be most forecasters, including ourselves, are saying there will be some form of recovery into 2021, if not slightly sooner. And I think at this point, it's probably worth reminding ourselves where property was going into this crisis, because this really is a crisis of has been a crisis of income. You know, it's not a debt-fueled boom and bust. Pricing in the market, say for some sectors, may have been getting a little warm, but in general, it wasn't overly exuberant. And supply-demand dynamics, pretty much for all markets, save for parts of retail, were pretty robust, pretty tight. So we think when the market kicks in again, that should support real estate going forward. If we skip on. So really, this is about income. And if you look on the chart on the left-hand side, you know, one of the attractive investments objectives of real estate is the attractive income return. So capital values do move. We have seen that this year. Again, most forecasts are saying that's going to turn around in 2021. It may even happen earlier than that if the investment markets continue to kick in the way it looks like they're going to. So it's a question of income. And I think we've seen, really, if you take retail out of the equation, the income has been pretty stable. We're still receiving the majority of our retail income. I think we're not through the woods there, and the we is the collective we, the market in general, and there will be more casualties. But overall, I don't think it's quite as bad as we originally feared. And this slide really summarises what most forecasters are saying, which is capital value falls at an all property level of around 15% for this year. And that therefore produces total returns of around about minus 10. And if you skip to the next slide, it's that dislocation again. You can see how total returns over the next 5 years for all sectors, apart from retail, are looking a little bit muted, but generally quite stable. But it's really those retail assets which are dragging performance down, particularly shopping centres. Okay, so looking forward, I won't go through all of these points. A lot of it has already been discussed, but I will pick out that we still have a few uncertainties despite COVID-19 and whatever happens there. There's still uncertainties in the market. We've still got to see what the Brexit deal looks like. There is going to be a holiday season, which usually accents the property market with a lot of activities over July and August. People are going away now, so it won't really be until the autumn where we'll see activity kick in. But we're quietly confident that it will, and the market will rebound relatively quickly. But we aren't through the woods yet. But I think at this point in time, there are evolving occupier needs. Certainly in the case of retail, certainly in offices, which I haven't really spoken about too much today. But again, it's about quality assets, core assets that occupiers are attracted to, which will I think prove to be the most resilient going forward. Okay, and final slide. Again, I won't go through all of these. These are our objectives as a fund in the short term, but I'll pick out 3 key points. We need to reinstate the dividends. As I say, the board will be discussing that over the course of this quarter. Rent collection, again, I mentioned it earlier. We need to bottom out those outstanding agreements with most of our tenants and bolster those rental numbers for Q2 and Q3, which are already looking relatively healthy in context. And final point, we need to drive through our business plans and our asset management initiatives. The world keeps turning, and we've got a lot of good initiatives in hand and upcoming. And we look forward to talking about them and discussing them with you in the fullness of time. So that's me. I guess over to questions.
Great, thank you, Matt. Yeah, we have a few questions come in. First up from Tim, to what extent are tenants renegotiating rents across your properties?
Okay, so if we take the offices and industrial portfolio, I mean, in the main, the concession that we've given is to allow tenants to pay rents monthly. We have had occasion where tenants have asked for a little bit more, such as deferment, but it's a judgment call. We're sympathetic to challenges their businesses might be under, and in some cases we have offered some deferments, but generally in the main it's monthly rent as standard. Where the businesses are under pressure, the next port of call would be to defer part of their rent. And generally, we're looking at Q2 and Q3 together as the period that most businesses are affected. So it may be a case with some tenants of deferring one quarter if they pay the other, or deferring 50% for each quarter. So that's the main, they're the kind of main body of the agreements. When it comes to the food and beverage operators, as I say, that's very much a live discussion at the moment, and that's where we may get into the territory of rent-free, because those businesses really do need it. And at St Christopher's Place, we've got a lot of independent businesses, and that support is paramount to their survival. So obviously we need to bend a little bit more there, which is absolutely the appropriate thing to do.
Cool. Okay. Couple of questions here on, well, one here on the offices. Have any of your office tenants indicated long-term changes to the way they will use the office, and what impact?
Yeah, so I think taking office demand overall, there will certainly be an aggregate change at a market level in terms of office demand. There's no question. I said it earlier in the. I will get onto the question of our own tenants, but just to frame it, I said it earlier in the presentation about it's not the technology that holds change back; it's the culture. And I think with home working, it was a real mixed bag in terms of businesses that adopted it. You know, even if businesses had good remote working facilities, and at least on paper people could work from home, there were still places where culturally it wasn't accepted, or you didn't want to do it too often because there was still a stigma attached. I think in a big way that's come off. I think it's not quite as black and white. It will come back to an extent. Most of the tenants that we speak to, we haven't had kind of formal feedback in terms of, right, we are reducing our portfolio by X, or we're changing our requirements. Most of the office tenants that we speak to have said they don't know what the changes will be ultimately. They will be, and many have said they will be encouraging more home working, but it's not in the main. It's not to replace the office. It's really to kind of complement the average working week. And I think the other thing we need to be cognizant of is, if, say, a business on average staff work, say, 2 days from home and 3 days in the office, because a lot of businesses, most businesses need to have an office present. If they're an office-based business, they need to have that hub. There will be days within that working week where the majority of staff are in. So if you take a Monday, you might have 80% of your staff in on a Monday, and say 40% on a Friday, typically. And therefore, you've got to accommodate those businesses. You've got to accommodate that staff at that point in a week. So the correlation between increase in home working isn't 100% with decrease in offices. So I think we have to be mindful of that. And my final point on that would be, remote working, as I said a second ago, it has been encouraged in a lot of businesses. Hot desking is standard in a load of corporates. I think we'll see a big change for the really big floor plates. The HSBC made an announcement recently that they can't see themselves occupying a building like Canary Wharf to the same manner that they were before. And I think we'll see that for the big floor plates. But I think if you own generally, core assets, core plus assets in strong locations, I don't think you'll see a huge amount of change in terms of overall demands, but the bigger end of the market certainly will.
Cool. Okay, a similar question. To what extent are tenants discussing resizing their property requirements? For instance, will they require less space due to reducing headcount?
Too early to tell, really. I mean, I think I answered most of that in the last question. The retail. If you take all of the sectors, retailers were downsizing anyway. They were consolidating their portfolios. They were strengthening their omni-channel offer, their online offer. So that's just an ongoing trend, and we just skip forward a few more years. In terms of industrial, it is going the other way. That market has been incredibly strong for the last few years, and that will continue. Incredibly tight market. And offices, it's too early to tell.
Cool. And then following on from that, then a question from Peter Lewis: do you foresee a big crash in occupancy in retail and office space in the medium term? And do you plan to shift your sector profile to industrial to compensate?
The answer would, on offices, the answer would be no. Again, I think I've answered it in large part in the last couple of questions. We're a core plus fund. We're at the safer end of the market, and there's a reason for that. It's resilient in the long term. So a fund like ours is set up for when there are challenges in the market. And if you own offices in central London and the prime spots around the UK, then generally there will still be demand for those offices. There might be some tweaks in rents, and I think it'll be a bold person who would be forecasting rental growth at the moment. But in terms of continuing that income, I think our offices in generally will be a lot more sturdy than some fear. There will be casualties. I think in the kind of more tertiary, secondary part of the market, there will be casualties. I think in the more recently evolved markets that have seen huge rental growth, and I'm thinking of, say, fringy London, like Farringdon or South Bank, Aldgate. You know, those markets might contract a little bit, soften, but no, I don't see a huge crash. In terms of retail, I mean, you could argue we're already seeing a huge crash. I mean, retail is going through a huge structural change. I illustrated it in the presentation. You know, again, we own two large core retail parks now. Because of how they were valued, with quite tight yields, now shift in yield that we've seen just through the market, that's really hurt us. But we have demonstrated that if your rents are sustainable and you're in the right locations, those tenants are still taking units, but their portfolios are shrinking. So they're reducing from 120 to 60 stores, for example, and they're taking 6,000 square feet, not 12,000 square feet. So the weaker end of the market is certainly suffering, and it's those parks which will be repurposed and dropped and turned into logistics or housing or whatever you can get planning for. Fortunately, we don't tend to be at that point in the market. But as I say, you could argue retail is kind of going through a crash at the moment. So as I said earlier, the acceleration of this trend, of this online trend, in some respects, rather than a slow, painful death, it's just a slightly quicker and more concentrated pain. But hopefully, we'll get to a more stable position for retail a lot sooner.
Cool. Couple here on bank covenants. Can you update on the Barclays loan covenant? Are you close to breaching it, and have you agreed a waiver with them?
Yeah, certainly. So no, we're not close to breaching it at all. I think so. The Barclays loan covenant is secured against St Christopher's Place, and the loan to value covenant is miles away. And the only covenant really to keep an eye on was the interest cover ratio. When the whole estate is fully paying, it's over 600%. And it's based on a rolling 12-month look back. So even with the 30% collection, it's actually a bit higher at the moment. I can't say too much because that'll be in the NAV, but and we're bottoming out those other agreements. You know, even where we are at the moment, even if that continued for another 4 quarters, we'd still be pretty safe. That loan does mature next year, and we are in pretty positive discussions with them at the moment, and they're very supportive.
Cool. We've got quite a few questions coming in now, so let's try and get through them in time. I know unfashionable in REITs, but do you ever consider buying your own shares at 50% discount to NAV versus buying new buildings at full value?
Yeah, I mean, it's a question that we do obviously have to ask ourselves. The last time we did that was in the global financial crisis. The one thing that we have to be mindful of in buying your own shares is you do tend to, if you do that, you do see a bounce in the share price. And once you've sort of broken that seal, the market then looks for that behavior to play that arbitrage, and it can encourage undesirable behavior, which can affect your share price negatively in the long term. Even if say you did it once, you know, you set a precedent. So no, we've got no intention at this stage in time to buy our shares.
Cool. To what extent does CapEx deliver increased rental returns? I.e., is increasing CapEx worthwhile, or is it more about bringing properties up to rentable standard?
I mean, CapEx is an inevitability with property. You know, the reason why property returns are, you know, drives a superior income return to, say, the risk-free rate, and why there's a premium there, is because it is a lumpier alternative asset class, and it's lumpier because you have void periods, you have rent-free periods, and you have to put CapEx into the building. That's part of the day-to-day, the bread and butter of managing properties. So, you know, we've got what I would say is a best-in-class asset management team. They're constantly looking to drive performance out of the assets. That comes with CapEx. We've had to spend a bit more recently than usual, really because of dealing with the casualties at our retail parks. which I touched upon. But no, capex is a good thing. It's essential. If you've got capex to spend on your buildings, it means you've got performance to drive out of your buildings. So as long as it's done on a sensible, risk-adjusted basis, it's it's performance accretive.
Cool. I think this one on St Christopher's Place, 30% of last year's footfall doesn't sound great. Do you see this improving much, given just how many corporates are saying their employees can work from home for the next 12 months?
No, it's not. Let's step back. It's not great compared to where we were last year, but it's not bad considering where we've been. As I mentioned, we were about 10% only a couple of weeks ago. And as I say, that's probably people just walking through the estate. It was pretty much closed, save for one or two, like a Pret coffee shop. 30% has been a big growth in a couple of weeks. We are right in the middle of these food and beverage operators and the retailers opening again. I haven't been to the estate since 2 weeks ago, and we've seen some pictures, and there is life. There's people sitting in the cafes outside. It's a bit like I've said. It's a bit like Brexit. You've got two distinct camps of the population. You've got those who are approaching things with timidity and think, I'm not sure if I'll go to a pub yet or a restaurant yet. I'll just sit back a bit. And those who are sort of piling in, as it were, and a large portion of the population are doing that, obviously weighted by age. Of course, I don't think we're going to get back to 100% anytime soon. Workers coming back into London and tourists is going to be slower than any other part of the country. The return to work is going to be hindered in London because of the limitations with social distancing on transport. There is no way around that. So it will be a tough year for the estate overall, and that's why we focus with a lot of our concessions being focused on that. The other thing I'd mention, and it's my own personal take, is you get to October, November time, and everybody's got a cough in a normal world. Everyone's got some kind of cold. If you have that now with the sensitivities of what we've all been through, there'll be people just generally staying at home. I don't think the return to offices will be particularly smooth, and I don't think it will be really significant until later in the year. There'll be big changes compared to where we've been, but I think we'll still have companies generally staying at home or encouraging staying from home if they can for a lot longer, or maybe a bit more of a split basis.
Can you describe plans for investments in properties that require changes to enable them to operate post-COVID?
Yeah, certainly. So our property managers have been all over this, and they've worked on the assets that we manage directly, as in the day-to-day property management, for facilities management. So therefore those multi-let estates, because obviously if it's single let, the lease agreement means the tenant takes care of the day-to-day management. But those with communal parts, etc. It's about putting policies in place. It's about being sensible. It's about putting the stickers on the ground, perspex screens or cordoning off so that there's one way in, one way out, cleaning facilities, antiseptic, hand gel, antibacterial hand gel, all those kind of things. They're the only measures that you can really put in place, and the tenants have to work with you on it. What we've certainly seen is that retail parks have shown to be far easier an asset to manage, because they've got the car parking, so you can use some of that for the queues. Albeit we're not seeing the queues anymore so much. Most of the operators are letting people in, and they've got enough space to keep the 1 meter social distancing. I think the big challenges will be the offices, really. Lifts, and there's no way around this. If you're going to keep 1 meter distance in a lift, you probably reduce the capacity by about 75%, and so getting in and out of buildings is going to be a struggle. Our offices are generally, like most across the UK, are not being intensively used at the moment, so we haven't really seen that stress testing. But they're the measures that we've put in place. So all the buildings can be operated, but it's just about being sensible and putting those mitigations in place where you can.
Cool. This is more general property sector, I believe. How vulnerable is the sector to outflows of foreign investment from the UK, i.e. Russian and Chinese money?
Yeah, I mean that would have some impacts on the market. What I would say is overseas money. It tends to get a lot of headlines, but it is focused very heavily on central London and the very prime end of most sectors, and say logistics. Big logistics positions, big opco acquisitions of, say, student housing companies. It's that kind of end of the market. So if that money was just disappeared tomorrow, maybe some tightening of the yields at the very prime ends might come off a little bit. But I would say if you look at central London, prime yields in central London, say arguably 4%. They still show quite a big premium against other European cities like Frankfurt, Paris, Munich, where they're trading prime offices 2.5%, 3%. The reason we feel London probably hasn't quite caught up is that there has been those uncertainties around Brexit, and that has hindered a huge amount of overseas investment in the UK over the last couple of years, and we haven't been immune to that. So if anything, if we can get through a sensible Brexit deal and move forward, we'll probably see inflows into the UK.
Cool. Compared to your general commercial property peers, you have traditionally paid a much lower yield, obviously due to high London weighting. Do you think that natural demand for income from shareholders might lead you to rotate out of London and to the regions?
Yeah, so we're not looking to increase our weighting in London at all. We have a pretty healthy London portfolio. We've got St Christopher's, which we discussed, and that will stabilise in the fullness of time. I mean, most of our investment strategy has been focused on emerging locations. Places like the Brain Belt, Oxford, Cambridge, Brighton, emerging cities. We're still looking at the logistics and industrial space. It has been a very overpriced market, so we've been wary not to just steam in and overpay for the sake of exposure. If you buy something at overpriced, your income and your total returns will suffer. So there's no point doing that just for the sake of weightings. But I think the trend that we're picking up, and it's the urbanization. If you take even if you take London or any regional city, industries are not as wedded to specific locations, as it were. It's far more fluid. And going back to the trend of remote working, you don't all have to be in the centre. A lot of businesses are moving out to Brighton, say, I use the example, where if they need to be in London, they can spend 2 days in London and 3 days in Brighton, or 1 day from home, or mix it up, however. So we think some of those kind of satellite locations around the cities and further afield are looking pretty interesting.
Cool. Okay. Well, we've run over, so we'll call it a day there. But thanks a lot, Matt, for your time, and that was very interesting. I hope everyone got something out of that. That was really interesting. Thank you.
Good. Well, my pleasure, Richard. Thank you, everyone. Have a good day.
Great. You too. Cheers. Right. We have Jason Bagley, who's the fund manager of Standard Life Investments Property Income Trust. Next, we'll just get him on the line. Here he is. Hi, Jason.
Hi, how you doing?
Yeah, I'm good. You?
Not bad at all. Thank you very much.
Good. You up in Scotland, or are you in London?
No, I'm in a very wet Edinburgh.
Yeah. Okay. All right. Well, yeah, I'll pass over to you, and just give me a nod when you need the slides changed.
Yeah, sure. If we can be on slide 2, that would be great.
Cool.
Right, so hello, everyone. My name is Jason Bagley. I'm the fund manager of Standard Life Investments Property Income Trust. I'm going to do a quick run through to give you an overview of where we are today, and talk a little bit, obviously, about COVID. So I'm going to start with slide 2, just sort of an update on some high-level figures. And in Q1, we had an absolutely appalling NAV total return. I'm going to talk about performance in a moment. But we did pay out our full dividend in Q1, And the reason we did that was most of the rent we received for that quarter before COVID hit. Income remains central to our approach and what we try and do. We had a covered dividend last year. We've always felt it's very important. It was not covered Q1. And at the time we made that announcement, we did say that future dividends are going to vary on rental collection. I'll talk a bit about rental collection in a moment. But I do not expect that we can maintain the current level of dividends, certainly not if we want it to be covered. And then very quickly on debt, the LTV is just under 25%, very low cost of debt. When I think back to managing the fund through the GFC, debt was the major focus of our attention. This time it isn't, and it isn't because there's so much headroom on the covenants, which is a nice change from a few years ago, where that was obviously the main focus of attention. So if we move to the next slide, please, performance. Now, a lot of what I'm talking about actually covers a wider timescale, but if I go back to December, we would have been positive over every time period. But in March, we had, frankly, a very poor quarter compared to our peers. But it's not something I'm going to apologise for, because I don't think our portfolio is any worse than our peers. When the valuations were done at the end of March, the valuers had a material uncertainty clause in the valuation. And we had a discussion with the valuer about, for us, that really meant that one could rely much more on sentiment than transactional evidence. And we marked down the valuer marked down every asset in the fund. And they hadn't necessarily expected to do that. But as we had the discussion, I said to them, well, look, I'd feel embarrassed to stand up and say that I could sell something for the same price or more 2 weeks into a lockdown than I could do December last year. When, frankly, at the end of the year, we were all quite optimistic. After the general election results, the market was feeling really quite good. I do believe that the market will play catch up with the approach we've taken, and I expect us to return to being a situation of reasonably good performance compared to peers, based partly on our asset allocation. So as I say, although we had 52% of the portfolio in industrial, every asset was written down in March. It feels like a long time ago already. We've obviously just gone through the end June valuations. Our NAV is due out in about 10 days' time. And so I can't really talk about it just at the moment. The next slide, slide 4, if I may. I wanted to just focus a little bit on the team. So, I'm very lucky. I get to front up the team, but I've got a wonderful team working with me on Slip It. So Ollie Lord is a deputy fund manager, has been involved for 3 years now, great at challenging me, helping me, pushing me, etc. Great addition. And then it's worth mentioning Graham MacDonald. His title is an injustice to him. I see him as my CFO stroke COO, and he makes sure that we do everything properly, that we have money in the right place, that we generally, he helps very much with our forward-looking decision making. And then I've got some superb asset managers. They have definitely been earning their crust over the last few weeks, dealing with tenants, working from home, and with all of the travails that provides. But it's not just the direct team we've got working on the fund. I'm also very fortunate in the skill sets which I can call on, be it a development team if we're doing a refurbishment project to make sure that the contracts are properly and soundly put in place, be it our tax and structuring team, our dedicated debt team. So very strong relationships with RBS, etc., who are our lenders, and a great research team as well. So moving on to slide 5. sector and regional allocations. To be honest, I'm not terribly bothered by regional allocation. I think we're probably as far as we'll go in Scotland at the moment, given the constant threat of changes in sovereignty. And I don't have anything in Wales, where generally I find land supply and planning just a little bit too accommodating. So region doesn't worry me too much. I much prefer to take a bottom-up approach to having an asset which works in a particular location. And then our sector split, we made a move a number of years ago to reduce our retail weighting and to increase industrial. We've always been quite heavy to industrial. I guess the dark blue, the third of the fund in offices, is probably something which most people will now look at and debate. I've been spending a huge amount of my time looking at the future of offices, etc. I don't believe offices are dead. I believe that the way they're used will change. I take umbrage a little bit to people saying that we've had a fantastic work from home experiment and everyone's going to continue to work from home. One of the reasons it has worked is everyone is working from home at the moment. I do feel that once we have some return to the office, then a lot of people will feel they're missing out if they're not in the office some of the time. I do not believe it is a cut and dry. People will be in the office 5 days a week or at home 5 days a week. The office will be used for learning, for development, for sharing, and actually for socializing. I'm very fortunate. I've got a lovely wife who looks after me when I'm at home, etc. When she's not working, and I can chat with her, and I've got company. There are an awful lot of people who actually rely on work as part of their social interaction, and so I don't think we can forget that the offices will still be a vital place. But the way they're used will mean that they've got to be of higher quality. I've been talking to a number of occupiers who are coming to the end of 10 years of occupation in a building, and they're saying, well, actually, we can probably manage with less space given the changes in working habits, but we expect to spend about the same amount on our office space, i.e. we'll reduce the size but improve the quality. And one of the things we've worked very hard at doing is providing office space where people want to work. So be that a locational with ease of access. Types of things I think are hugely important and becoming even more important are having superb shower and changing facilities. It's no longer sort of appropriate to give someone an old broom cupboard where you're stuck in a poor quality shower and expect 20 people to share that. So we create lovely facilities. In a number of buildings we've been able to have shared meeting rooms which you can book at reception. A yoga studio, for example, in a couple of our buildings. So creating places people want to work is really important, and I think will drive occupation. The other thing we did, which we fitted out quite a few of our units. So if you wanted to move into an office, you don't have to worry about the fit out. We've already provided it, very functional. The only thing you really need to bring is your mobile phone and your laptop. We even provided the mugs and the sweets on reception. And during lockdown, we've completed a lease on one of those. We've agreed terms and nearly completing a lease on another one. We are seeing that where occupiers are moving, they want things to be ready to go to minimise their own capex. But we're getting quite a good return on those investments. So if I can move, I'm actually going to jump 2 slides. Asset management was just a recap of what we've been doing. Obviously, it's vitally important to us, our interaction with tenants and so on. But in the interest of time, I thought I'd just give an update on some, I say recent purchases. We didn't buy anything this calendar year, but our most recent 2 are here. An office on the outskirts of Edinburgh. Now, why did I buy something which wasn't core central Edinburgh? Partly attractive pricing, low rents. I'm a huge believer in affordability in the buildings we own. This had a Tesco and a pharmacy on the ground floor, offices above. We've actually just done a very minor refurbishment of the top floor, which was vacant, and it's in solicitors' hands at the moment. The location works really well because it's close to the university and sort of the tech hub. And it's also got good car parking, which I believe is important because I think Edinburgh, along with many cities, will start charging people to drive in the future. and this will be just outside where I'd expect that charging point to be. And then Aberdeen, obviously Aberdeen is out of favour because of oil price, but actually renewables are a huge part of what's happening in Aberdeen. What I liked about this unit, apart from a very attractive yield, let on a long lease to a good covenant, is exceptionally low site cover. I could actually build another unit of about 25,000 square feet at the back of the site, and you still have 2 really good specified yards, etc. And then slide 8, a couple of sales. So we sold an office building in Staines at the beginning of the year. Staines historically was a fantastic recovery town, but I'm a bit worried about it at the moment. It's missed out on some infrastructure improvements that we're seeing down the Thames Valley with Crossrail, and it's never really recovered for some flooding a few years ago, in perception terms at least. We'd actually taken the old tenant out who was downsizing because we'd found a new tenant for the whole building. We were at a sort of a top of a capital value cycle, so we realised the profit and came out of that one. And actually, that's how what we sort of think about for selling generally. It's reducing risk and realising profit. Always been a fan of realising a little bit of profit. And Denby was a great example of that. The tenant there, great, it's a superb shed. If you like your sheds, this is a lovely shed. Tenant was very happy there, but actually was storing and distributing boilers, which were made nearby. Both our tenant and the boiler manufacturer are owned by a German company. We were having discussions with them, and it's quite clear that Brexit was influencing their future decision making. And if they left, the hole in income would be very great for us. So we felt it was better to recycle the money and actually effectively replace that income through Aberdeen at a much bigger yield. That's probably it on that slide. So I'm just going to go to slide 9 and ESG. In many ways, it sounds a little bit contrite saying central to everything we do. It is, and I almost get bored that people keep asking about energy efficiency, etc. Because frankly, that's old hat. The energy efficiency is something we've worked on for a long time with making sure that we have the right lighting, great insulation, etc. The social is a much more interesting aspect. It's the hardest one to actually sort of put a finger on and do well and measure. One of the things which I was really delighted with was I got a call from one of our facilities managers saying, if it's okay, I'm contacting all the tenants in the building to ask them if I can take all of their biscuits and tea, etc., which they won't be using and will go out of date, and give them to the local hospital. And it's a building where we often do food banks, etc. The sense of community that creates, because obviously the occupier then tells their staff about what they've just done, and that really seems to work very well. So just an example of the type of thing we're trying to do. I'm just going to move on to the next slide, if I may, because I'm not renowned in the office for buying the most photogenic of buildings, and this is a great example of why I like to take a photo of the roof rather than the actual building. But this is the largest photovoltaic installation Aberdeen Standard Investments has done in the UK by a factor of 2 or 3. We just completed it for Slip It. So it covers the roof of a building we've got in Sandy, which is let on a long lease. Really excited. So we sell the power to the tenant. We're getting a return of just over 7% on that. And the tenant's getting obviously lower price electricity, but also green electricity. And it's meeting about 25% of their on-site needs. So they're quite a heavy power user. That's the type of thing we're really interested in trying to do, is to work with our tenants to come to solutions which work for both of us. So slide 11, COVID. Obviously, I talked about the valuation movement. That material uncertainty clause is being lifted across different sectors. It's likely to remain in place for retail for quite a bit longer. and although it's being lifted, there still is a shortage of transactional evidence. I was quite delighted. I received an off-market offer on one of my industrials, which I haven't accepted because it's a great asset, where the trading costs would be too great for me. But it was effectively at valuation, and that was just their initial approach. So it gives me confidence in the approach we've taken on valuations. Rental collection is probably one of the biggest aspects of COVID. And frankly, we've had quite a mixed experience. I can remember that a week into lockdown, having a phone call from a young lady who, we have very few small independent tenants, but she's one of them. She runs a tanning studio, and so it's, in the context of the fund, it's tiny. But she was very upset about how she was going to pay her rent, and she said, you know, can I not pay this quarter, and I'll pay it back to you next quarter? I said, to be honest, no. And the no bit is, you can't pay it back next quarter. There is no way that you will recover the lost earnings during lockdown to be able to pay it back so soon. And actually, 2 weeks into lockdown, there was so much uncertainty. I said, do not worry, you don't need to pay your rent. We're not going to take any action. We will sort it out once we have greater visibility of how your business can perform. There's no point in that lady worrying about how she's going to feed her family and whether she's going to lose her livelihood when there's nothing she can do about it. So, you know, that's one end of the spectrum. And then I find I've got a data center, which is, you know, data centers are going great guns during lockdown, and we're really struggling to get the rent out of them. We will chase that with vigor. There is no reason for that whatsoever. And in between, I've got one tenant who I actually wanted to shorten their lease, and they'd asked for a rent-free period because they're shut, and we said, well, I'll tell you what, we'll give you a longer rent-free period if we can have a landlord break in 5 years' time. And their response was, no, we don't want to do that because we're going to make so much money out of the building in the future. Well, my personal feeling is, if you're going to make that much money out of the building in the future, you can pay some rent now. So we have some battles where the split between landlord taking pain and equity owner taking pain doesn't feel equitable. And we try and treat it on a case-by-case example, working with our tenants. Rent collection, I can't say too much about the figures. Obviously, it's improved since this was provided, but that will come out in the NAV statement, etc. And I think perhaps in the context of time, I'm as well drawing to a close then. Slide 13 is just a summary slide. I'm a huge believer with Slip-It of trying to keep things simple. We try to act efficiently and quickly. We will continue to do what we've always done, focus on income, do the fundamentals well, and be cautious in our outlook. And Richard, I wonder whether now's a good time to perhaps move to questions.
Yeah, of course, yeah. Thank you, Jason. Let's have a look what we've got in. Starting to come in now. We had this in the BMO presentation, but it'd be good to get your thoughts on it as well. To what extent are tenants renegotiating rents across your properties? I think you touched on that just now.
Yeah, to be honest, we've not had any sort of tenants saying we would like to reduce our rent. They either don't want to pay anything, or we're looking at payment terms as opposed to the rental level. And actually, we've still had a few rental increases through rent review and a lease renewal during lockdown. Needless to say, that was on the industrial sector and not on the retail aspect. So it's more about whether people can pay rather than the actual level of rent.
Okay. To what extent are tenants discussing resizing their property requirements? For instance, will they require less space due to reducing headcounts?
Yeah, so the headcount's an interesting one. Yes, generally, but most people's lease commitments are slightly longer term than a short-term cut in headcount. And what we have seen is a number of companies who were looking, let's say, for 100,000 square feet because they wanted to, they only needed 80 today. They're going to move in 2 years' time. So they put a requirement for 100, thinking about growth. They're now saying, well, actually, let's not worry about the growth. Let's just go for what we need, the 80. We'd already seen lots of examples of someone coming to the end of, say, a 10-year lease. They had the same number of people. They could do with about 20% less office space. You know, maybe that 20 becomes 30 with more agile working. But I think more important than the actual amount of space people need will be the quality. So actually, one of the things we're being very careful about is making sure we retain assets people want to work in. Obviously, you know, this isn't a big fund particularly. We don't own sort of a huge office with huge foot plates. So actually, one of the areas where I think we'll do very well is people moving out of flexible office space into our fitted suites, because they want their own front door, their own environment. They can create their own culture, but also a feeling of control.
Yeah. Cool. When will rent deferrals start to be paid again? And assuming they are, will this be reflected in increased dividends beyond the normal level?
Yeah, so that's a really interesting one. I mean, we always like to think that we can smooth dividend and not have, you know, the up and down, up and down, up and down. I have to say that in my general calculations, I'm ignoring deferred rent when it's going to get repaid, as part of my cautious nature. But when they start being repaid, it depends on tenant to tenant. We really have taken an individual approach with every tenant discussion. Some are starting at the end of this year to repay over 6 months. Some are repaying over 12 months. Some over 18. Some are due to start repaying in Q3. You know, the reality is, one of the things we learned very early on is it's really easy to agree something very quickly without knowing how it's going to play out, and then you have to have more discussions. So in week 2 of lockdown, we found people were saying, can we have defer this quarter and start repaying next quarter? Well, that hasn't been functional because they've had no income coming in. People who wanted to go just to monthly rents then came back and said, actually, we might need to go to a deferment. So it will all come through in future income. Can I say, yes, it's likely to lead to an increased dividend of X% for a period of time? I don't think so. I think we'll be looking for a sustainable dividend and a covered dividend.
Okay. Cool. Why did Sly's industrial portfolio fall 5% in the quarter to March when this sector is said to be performing the strongest?
Yeah, so when the valuations were undertaken, there was very little evidence, and there was we took an approach of basically saying, look, sentiment is negative across all sectors. Could anything transact at the same level as it did last December? There were a couple of specific issues. So one of my larger tenants, so this gives you an example of how every sector is impacted by COVID. One of my larger tenants occupies a logistics unit and stores and distributes toilet rolls. Now, we may have forgotten it now, but back in March, toilet rolls were the hot commodity which everyone was talking about. Needless to say, I thought, fantastic. If I've got a tenant that's going to be doing well at the moment, it's my toilet roll distributor. As it happens, they were really struggling because they're paid by the pallet they store. And the demand was so great in supermarkets that the toilet roll was being manufactured in Italy. When it got to the dock, it didn't come to our unit to get distributed. It went straight to the shops. So it just shows you how. So we reflected the fact that tenant's income was reduced and then we had one other unit where we had a vacancy coming through. We took a very cautious approach, and anything which had a short lease or a break, we increased our assumptions around that.
Okay, cool. One here on lighting. You touched on lighting. Are you considering UVC in your estate for sterilisation?
No. So when I was talking about lighting, I was thinking very much more about LED as opposed to other forms, halogen lighting, etc. So energy efficiency lighting. We've worked very hard where we've got common areas in multi-let buildings to come up with a cleaning regime, etc. But we haven't installed UV lighting, and in most cases we've decided that use of heat cameras isn't appropriate. It's being used in some areas, but for most of our offices we haven't done that either.
Okay. How much of your portfolio is linked to capex on solar panels and the income derived from this, and how do you see this trend continuing? When does a REIT become part infrastructure fund?
Yeah, unfortunately, it's still a very minor part of income. I'd imagine sorry, I don't have the exact figure, but it's more likely to be sort of half of 1% to 1% than it is anything else. Would I like to increase it? Yes. I believe that we should be putting as much photovoltaic on top of buildings as we can. The income return at about 7% is always going to be much less than the rent, but it's going to help us future-proof assets as well. So not only does it help our carbon footprint, but for many occupiers, they're very worried about their credentials as well. So do I see it increasing? Yes. Do I see it becoming a significant proportion whereby we should consider a classification? No.
Cool. What are the advantages and disadvantages of scale for a REIT?
The advantages are generally, well, there's two sides to that. For an investor, scale can provide better liquidity in the stock. As the other aspect of size, obviously, is what you can invest in, but also your cost basis. So REITs are relatively expensive structures to manage with the listing requirements, etc. So it needs to be of a minimum size to make that worthwhile. That's generally considered to be around, so gross assets around 250 to 300 million. I think there are a number which are a bit subscale, and that will impact. It's also it's that freedom to be able to invest where you want to and find value. A disadvantage, of course, of being very large is really you can only buy large assets. Otherwise, you end up with this long tail, which lots of research shows that tail is disruptive to performance. Whereas, the size we're at, we can invest through a range. We've got assets at 5 million. We've got assets at nearly 25 million.
Cool. Got a question here on an email. Let me just get it up. Why has a fund that is 50% focused on industrial and logistics seen its rating hit disproportionately compared to fully focused logistics companies?
Yeah, so I think there are two or three things there. We've generally traded on a smaller discount to a bigger premium than our peers. Over the last 2 weeks, we've sort of come in line with them. Compared to focused REITs, I think we are still considered to be a generalist, which is probably correct. We've got 52% industrial rather than 100%. Frankly, we've had a big seller. And one of the things which I think we've benefited from for many years is seeing a fairly constant small buyer. So the man on the street, 5,000, 10,000 shares, but constantly sort of ticking over. That buyer seems to be very quiet at the moment. What we're finding is transactions in much larger sizes. So we've had a larger seller, but we've also had a couple of large buyers. So we've had some short-term volatility. I don't know if that answers the question or not.
Yeah, no. And another one here on offices. Obviously, like I think you said in your presentation, that's the big talking point at the moment. Do you see office space requirements reducing in the long term?
Yeah, so I think there will be a reduction, certainly over the medium term. I mean, in the long term, it's very difficult to know because of what happens through growth, etc. There are a number of factors affecting that reduction space. It's already been ongoing. But actually, if I think about the offices we've got, they accommodate a variety of sizes, apart from the very large. And as people downsize, maybe more people move into that. I don't know. I think it's really easy to talk about size. I don't think size is naturally what matters. I think we need to be very careful about offices which will not function as offices. So if you do not meet certain requirements, I don't think it really matters what the size is. I don't think you'll be relevant to the office market. So people will occupy better quality with better facilities. And I think the other aspect is, if I go back to different recessions, we've generally had much higher levels of supply. Supply is still quite constrained. And one of the reasons it remained constrained was change of use. So as poorer quality offices became needing refurbishment, rather than being refurbished and still being relatively poor quality offices and holding down values, we saw them change use quite a lot. Some of that was to hotels. I don't suppose we're going to see quite so much hotel conversion over the next year or two, but a lot of it was to residential, and that is likely to continue. There is still a huge demand for residential, and so we'll see office conversion there. And actually, I think there's going to be a huge amount of change in that residential market as actually, if you're building new today, will you accommodate greater facilities for people to work from home? So actually, that you just get a shift actually in some of the demand requirements, and it takes out a different part of the stock.
Yeah. So what are your thoughts on the planning changes recently and permitted development rights on shops into residential and stuff like that? What would that impact would that have on the high street?
So one of the difficulties of the high street, obviously, is a very fragmented ownership. So it's quite difficult to take a whole high street and say, right, we're going to rejuvenate this, because so many different players involved. I think anything is great which helps people rejuvenate property which isn't wanted for its existing use. I mean, if you look at so many high street shops, they're becoming dilapidated. The ground floor may or may not be occupied as retail. You can more or less guarantee that if you get 2 stories up, the main occupant is a pigeon. You know, so that rejuvenation and the ease of changing use, I think is fantastic.
Do you not think there'll be some residential developers who will just sort of try and squeeze in tiny houses or tiny flats and sort of escalate the problem in that sector?
Look, if they provide something which the market doesn't want, they won't sell it. You know, I'm a little bit a believer of some market dynamics. If it's being used as a provider of affordable and social, then maybe they'll get away with it, and that's a slightly different market. But you know, one of the things we have to develop and deliver it is an increase in affordable housing.
Yeah. Okay. Cool. Last one before we go. You touched on the LTV being just below 25%.
Yeah.
Can you just talk through the covenants there? Are they all sort of fine? Yeah.
So the covenant level is 60%. So there's lots and lots of headroom there. And on the interest rate cover, if we only collected 30% of our rent, we'd still meet the covenant.
Okay.
And I'm pleased to say we're collecting more than that.
Yeah. Okay. All right. Well, that's the end of the questions, and we're just about on time as well. So thank you, Jason, for your time. Found that really interesting.
Thank you very much. It's delighted to come along.
Great. All right. All the best.
Thank you. Bye.
Yeah. Right. Okay, next up we have Thomas Edwards Moss, Chief Financial Officer at Hibernia REIT. Are you there, Thomas?
I am, Richard. Morning.
How are you doing?
Very well, thanks. You?
Good. Yeah, I'm good, thank you. We've just got a couple of minutes till we're due to start. So if it's all right with you, I think we'll take this chance to have a sort of comfort break. That's all right?
Sure, of course, cool. Yeah.
Thank you. Great. I think we can crack on there. You right to start now, Thomas?
Sure. Thank you. Thank you for having me, Richard, and good morning, everyone. Richard, do you have my do you have the presentation that I sent across to bring up on the screen, please? Thank you. And do you think we might be able to start on slide 39, if that's possible, please?
I've got different numbers here. Is that?
Oh, okay. So towards the back of the deck, so you're probably looking. There's a page just in the first page of the appendix has got a map in there, which might be quite useful just to talk through.
Sorry, I didn't get that.
Sorry, the first page of the appendix, if you go to the very back, has got a map that it might be quite useful just to talk through.
This one?
Yeah, please. Thank you very much. So I suppose just to give a bit of background to Hibernia, what we're about, where we have come from, and I suppose where we're likely to go. I think this slide is a good one to talk through. So Hibernia is an office specialist. All of the offices we own are in the city centre in Dublin. You can see that on the map on the right. Our business model is really focused on improving buildings, whether through redevelopment or refurbishment, and generating value for shareholders through doing that. We don't have any. Our portfolio at the moment is about €1.5 billion. We don't have any particular ambitions of size. So when we're more returns focused, so when the opportunity to sell assets comes along and recycle capital into new opportunities, we're happy to do that. We also have about 85% of our portfolio is what you can see on the map on the right, so the Dublin city centre offices. We also have an allocation in about 10% of the portfolio in residential, which is another area where we, I suppose, favourable supply-demand dynamics. I suppose looking at the sort of history of Hibernia, it was founded 6.5 years ago. The chief executive, Kevin Nolan, was one of the founders, and really he was at the time working in NAMA as one of the asset managers within the National Asset Management Agency, as it was then, which was basically the bad bank for all of the property that got into trouble in the crisis. And we can go into more about the difference perhaps between the property market today and how it was in 2007 in due course. And the opportunity that I suppose Kevin and the co-founders saw was really that most of a huge amount of Dublin property was in the National Asset Management Agency in the form of distressed debt and or bad loans, and really there wasn't a long-term home for that property in future, and really that was where the opportunity to form to introduce REIT legislation came from, and with the intention of creating a sort of long-term vehicle which at its inception would take advantage of the dislocation in the Irish property market to buy property cheap, and then over time would become a perpetual vehicle that invests for the long term. And that's, we raised about 660 million euros of equity funding. We've since borrowed around just under 250 million euros, and the portfolio is now worth, as I said, just shy of 1.5 billion. So as you'll be able to point out, that's the equity, if you like, in book value terms, is now up to about 1.2 billion euros. So it's been a pretty successful period for the company, and really starting from nothing, and we've had to buy all of the assets as we've gone along. I guess if we when we started off, the buying was probably the bigger part of what we were doing. We've now assembled this portfolio, and as I'll go on to talk about it in a bit more detail later, there is substantial opportunity in future to within the portfolio for redevelopment. So we own a mix of buildings, some of which are brand new, which we've delivered ourselves, and then some of which are much older, 1960s or 1970s stock, which in due course we intend to knock down and redevelop. And that's I suppose how we like it. So for the last few years, and I'll show this on another slide in a minute, more of our activity has been focused on build, if you like, rather than buying new assets, and we've been pretty active in the development space. I should also say, just in terms of strategy, one of the things we, as anyone who's been to Dublin will know, it's a pretty low-rise city, and until recently there were very stringent height restrictions on how tall buildings could be, and even now those have been somewhat relaxed, but you're only allowed to build in kind of character or in keeping with your surroundings. So again, it's unlikely that you're ever going to see, in the near term, you're going to see any kind of sort of 30-story type skyscrapers going up. It's likely to remain a low-rise city, and one of the I suppose challenges that gives to landlords and occupiers is most office buildings are not much bigger than 100,000 square feet. And in that scenario, it's quite hard if you're. It's fine if you're Google or someone, you're taking the whole building. You can fit it out as you want, and you probably have room to put the kind of facilities in that tenants and your staff require, namely, gyms, breakout areas, etc. But if you're a tenant taking 10 or 20,000 square feet in a multi-let building, it's quite hard to be able to pay for that within your building. And one of the concepts we have come up with, therefore, is clustering office assets together. So where you can get several buildings either adjacent or adjoining, you can then share facilities between them. So you can put in more more retail space, more leisure space, etc. And you can see, I suppose, the first example of that on this map is really, it's not particularly clear, but if you can see just south of the river, you can see the assets 11, 7, 6, and 5. Those are 4 office assets. There are actually 1 or 2 other assets, smaller assets alongside them as well. So in total, we own, it's what we call the Windmill Quarter. We own 400,000 square feet of office space there, with town halls, gyms, retail units, etc., which we think gives a much better, I suppose, experience to the tenants and to their staff. And that's really been our first example of doing a cluster, if you like, and it's been very successful. Most of that space we've delivered ourselves, rather than buying. We've also got, I suppose, within the pipeline, I alluded to the fact we have longer term opportunities. If you numbers 17 and 13 on the map are 2 1970s groupings of buildings where we can repeat that process in due course, i.e. Increase the density on the site, but also create clusters of office assets. So I suppose that's perhaps a little bit about Hibernia and the strategy. Richard, if it's possible, just to go back maybe 4 or 5 slides, that would be very helpful. There's a page called Portfolio Summary. If you just keep on clicking back another couple, please. 1 more. Okay, so just to give you a bit more color, I suppose, on, I won't labor this slide, given it's just a set of numbers, but you can see how our assets break down. So city centre offices is about, as I said, about 85% of the overall portfolio, if you include the assets we have in development, which are pretty small. And then we have the majority of the rest of the space is in residential rather, which is just over 10%. And we have some land or industrial units, which in due course we hope to get rezoned for future residential. Richard, apologies to ask you to move slides again, but perhaps we could go back to the start of the presentation now, please. Okay, just back down 1 more, please. Okay, so just in very brief terms, I mentioned we have about a 1.5 billion portfolio right now. Our debt levels are pretty low, so under 250 million euros of debt, and a loan to value ratio of under 17%, which makes us one of the lowest levered REITs within Europe. And that's really, I mean, we see our natural leverage position through cycle is probably 20 to 30% rather than the current levels. But I guess the current leverage level is really a function of history, where we come from, but also our wariness of deploying too much capital when the cycle felt like it was close to the top, and we were happy to be patient and wait a little bit further. On the income statement side, rental income has been growing substantially over the last few years, mostly because we've been finishing out developments. We've gone through a pretty active development phase, been finishing out developments and letting that space up. We think there is still, even notwithstanding COVID, we think there is still potential to grow net rental income a little bit. I'll come on to the reasons why in a minute, but so you may see a little bit further incremental growth in the near term, but it's probably going to be relatively modest. And ultimately, we're now spitting out a 4.75% dividend, which on the current share price of about somewhere around the 110 level is kind of close to a 4.5% dividend yield. Maybe just moving on 2 or 3 slides, please, Richard. Another one, please, and 1 more. So in terms of the balance sheet, just to give you a little bit more color, unsurprisingly, with a LTV of only 16.5%, we have very substantial headroom on our covenants. The Irish REIT regime has and you can see this bottom left in that table. So the Irish REIT regime has a max loan to value ratio of 50%, and our debt covenants are aligned with that. From where we are today, that means effectively the portfolio value could fall 65% before we would be in breach of our loan to value covenant. On the earnings side, we have to have interest cover of 1.5 times. So our earnings could fall from this point over 75% before we would be in breach on the debt side. And maybe just to say as well, on the right hand side, you can see how our capital allocation has gone through the years. The company was founded in 2013, so our very heaviest buying was in 2014 and 2015. But you can see how we've been in the last few financial years, and you'll see, I suppose, the green line is how the LTV's ticked up over time, and then the red line is our net capital spend. So you can see over the last 2 or 3 years that's come down materially. And also looking forwards to 2021, we have little in the way of committed capex. We have one small development or relatively modest sized development to finish out with under 20 million of capital committed to finish that. And that's really it on the current committed development exposure. If we could just turn on one slide, please, Richard. So I suppose rent collection is a big focus, and at the moment for investors in the market, and we've been quite fortunate, as you can see on the left hand side of the slide. The majority of our tenant base well, about 90% of our rental income comes from commercial, which is mostly office, and of our office tenants, the majority are either in the TMT sector or are government or state-backed entities. So our risk level has been relatively low, and to date our rent collection has been pretty good. This presentation was actually from our preliminary results in May, and it's available on our website if anyone does want to sift through it in more detail later. But I suppose so the rent collection stats on the right are slightly out of date, but I suppose to give you to give you the current position, I suppose if we look at the quarter ending June, so which was a 1st of April Gale Day, on the commercial side, we collected just shy of 90% of our rent within 7 days. As at today, that number is now up to about over 95%, with about 1% of rent still outstanding, and another 3.5%, which we've agreed with the tenant, has been deferred until later this year. And then if we look at the quarter ending September, which isn't shown here, but we announced this a week or two ago, which was a 1st of July Gale Day. Again, our rent collection was fairly consistent. We collected 87% of our rent within 7 days. There's about 7.5%, which is now on monthly payment terms, which we will expect to get in over the next 2 months as the quarter runs out. And then as at that 7 day point, there was another 5% of rent outstanding, which we expect to make progress on collecting in the near term. And we have a trading update out next week as well, so I suspect you may see further progress when we announce that. If we just turn on one slide, please, Richard. So I mentioned earlier there were the kind of potential for further growth in rental income, which we certainly wouldn't want to overplay. But in the near term, this is just these bars are effectively our contracted rental income. So you can see the navy blue one far left is effectively the position 12 months ago, as at 31st of March 2019. In the year to March 2020, we grew the contracted rent substantially principally through new lettings and rent reviews. As we sit here today, with our contracted rent around 66 million euros, there is actually still some vacancy in our existing office portfolio. So there is potential to add, and I'm not suggesting we're going to do this tomorrow by any means, but there is potential to add, as much as another 5 million from vacancy in the existing portfolio. And secondly, we we have a one office building, 2 Cumberland Place, which I mentioned earlier, is still in construction. And when that building is let, there is potential to add another up to 3.3 million of income from that as well. So our contracted rental income may grow further despite what's going on with COVID. And I suppose in the medium term, we have a number of large office development projects that we have planning permission for, and while those would result in a sort of short-term decline in our rental income, the ultimate uplift in density we can put on the site and will significantly increase the amount of rent we can pay, or we can receive rather, so we can charge. So we expect that there will be potential to grow our rent very substantially in future through future developments, capital expenditure. Maybe if we just move on one, please, Richard. Actually, we might just go to, sorry, I'm happy to talk about sustainability to the extent people want, but we might just move on to 2 or 3 more slides to the market now, if that's okay. One more, please. Okay, so I suppose one of the areas that's probably of interest would be the market and where is it in Dublin at the moment. And I mentioned earlier that we feel that the property market is quite a different place to where it was in 2007. So maybe to expand a little bit on that in my opening comments at least. So in 2006, 2007, Dublin was very much a closed property market with actually 0 overseas investors participating. And as I'm sure you'll be aware, there was effectively a large property bubble developed, which was effectively debt fueled by some fairly reckless lending by the Irish banks. And it was also a market where there were a number of developers who were aggressively building buildings, borrowing money and using personal guarantees. And effectively, when the financial crisis happened, most of those developers went bust, and there wasn't really a lot of private landlords had excessively levered themselves as well and went bust as well. I suppose where we find ourselves today is the Dublin property market, the Dublin office market, is much more institutionally held. So the majority of city centre offices are owned institutionally now, in vehicles with much lower leverage. Secondly, because all of the developers went bust, there has been, and the banks had near-death experiences as well. The development cycle has been very much different this time, much more controlled, and has relied much more on pre-leasing, which mostly because the banks have been refusing to lend to anyone doing development work unless they have pre-leases in place, or unless they're a party like us with a reasonable sized balance sheet, where effectively the assets are, any lending that we get from a bank is effectively backed up by a portfolio of income producing assets, which gives them comfort to lend. So there's been a much more controlled development pipeline, which we'll come on to see in a minute or two. Just in terms of the how I suppose the take up has trended over the last few years, you can see on the chart top left, there's been a pretty strong few years of take up running into 2020, and indeed the first quarter of 2020 was very strong as well. We can discuss maybe in Q&A a little bit more the reasons for the strength of that. I think certainly foreign direct investment has played a large part. There's been a large influx of technology companies to Dublin. I think personally that's been helped to some degree by Brexit, even if not overtly, and it's a thing we tend to call latent Brexit. Unsurprisingly, Q2, which isn't shown on this chart, but Q2 had negligible amounts of take up. So if there was close to 1 million square feet taken up in the first quarter, in the second quarter it was 100,000 square feet, something like that. So very, very small, as the market was completely shut down. We are starting in Dublin, offices have started to reopen. The agents are back at work. we are aware of a number of large letting transactions that are still proceeding at the moment, although they haven't finished. But I guess it's still early days to see exactly how active tenants are for the rest of this year in leasing space. Unsurprisingly, you can see bottom left, active demand has slowed down as the impact of COVID has started to be felt. If we could just shunt on, Richard, a couple more slides, please. To this one, yeah, perfect. So this is the supply side picture as we sit. Well, this was from May, but it hasn't radically changed since this point. On the left, you can see the city centre office supply, and then on the right, you can see the whole market, including both city centre and suburbs. So we focus more generally on the chart on the left, given that that's where all of our office assets are. You can see that there is the kind of royal blue bars are the space under construction at the moment, and the red hatching is in those bars is what's already been pre-let. So you can see that in 2020 and 2021 already a substantial amount of the supply that is coming has been pre-let. Now, if there are no more lettings this year, which we think is unlikely, then clearly vacancy will tick up. At the end of March, it was around city centre vacancy was around 5% for offices. It had reached by the end of June, it was up to about 6.5% because basically there was no take up in the quarter, and clearly it will continue to rise further if there is no take up for the rest of the year. However, we believe that there will be lettings done this year, and so the vacancy rate will not rise as much as might otherwise be the case. But in any case, the amount of supply that is unlet is we think relatively manageable. That maybe sort of covers off the market, but I'm happy to take any questions on that in Q&A. Maybe Richard, if we could just move on a few more slides, please. There's a slide. If we just keep on ticking through, please. One more, please. So maybe just to give you a kind of example of the type of projects we like to do. This is a CGI of a building we have called Harcourt Square. It's currently a pretty ugly 1970s office comprising 3 or 4 buildings. It's about a 2-acre site, and it's about 120,000 square feet of offices let to the Irish police at the moment. We will be getting the building back at the end of 2022, and we have planning permission to put a scheme of almost 340,000 square feet on the site. This is within kind of 100 to 200 meters of St. Stephen's Green, so it's right in the very centre of town. But this is the kind of project we like to do, which is, i.e., taking a rather inefficiently used central Dublin asset in a fantastic location, but which is a poor asset, and knocking it down and building something of considerably higher density, with the potential to form effectively another cluster. It remains to be seen whether this building would be delivered as effectively as a single let, or whether it would be a multi-let building. It's effectively two buildings which are conjoined, but we can do either. So there's quite a lot of flexibility there. And maybe the last thing just to say, Richard, maybe the last slide to turn to would just be the very last one in the pack, if that's all right, please, in the appendix. So I mentioned as well, we have, sorry, yeah, there we go. I mentioned as well, we have some land holdings, and in due course, our intention will be to try and get those rezoned. This is on the edge of Dublin, so it's about I think 8 miles into the city centre from here. We own here about 144 acres of land, so the land in red, the majority of which is currently zoned as agricultural land. This is actually where the Irish Rugby Football Union own owns a large amount of land which we bought from them, which was originally a place where they were thinking about putting a rugby stadium to replace the Aviva, which luckily they didn't do for all sorts of reasons. But this is we think in due course there is an opportunity here to get the land rezoned for mixed use, but primarily residential, and that's something we would have an interest in delivering some of ourselves. I mean, obviously it's a huge site, and I don't think we may well not be able to do all of it ourselves, but the first step is really to try and get the land rezoned, and then we can work out what we may deliver ourselves and what we may ask sell to the house builders or others to deliver as well. But I suppose it's, whereas we've bought offices directly, and we have a pipeline of future development projects on the office side. On the residential side, the PRS space has been extremely aggressively bid for the last few years, and we really see the better opportunity on that front to delivering the units ourselves rather than trying to compete with the ways of capital trying to buy investment grade PRS assets when completed. I might just appreciate I've spoken for quite a long time now, and we've done a pretty quick tour through Hibernia. Rich, I might, if it's okay, hand back to you to take any questions that people have.
Yes, of course. Thanks, Thomas, for that. Let's open up the Q&A. So we have one here from Peter Lewis. Roughly what proportion of your tenants are US tech companies, and do they prefer city centre or out of town sites?
Hi, Peter. So broadly, about 50% of our tenant base is in the TMT sector, and the vast majority of that is US tech firms. Generally, we found that they prefer city centre locations. A lot of the staff they're trying to recruit will be young people who are living or prefer to live in the city centre. The suburban office parks tend to be much more sedate in terms of pace of life, and also in some cases require cars to get to them. So the vast majority of the US tech firms have chosen to base themselves in city centre Dublin. There are one or two like Microsoft that are out in the south suburbs, but they're a relatively small proportion of the overall number.
Cool. Question here on the shares. Who owns your shares, and what's the liquidity like?
So liquidity-wise, probably around 2 million shares trade a day, something in that order, maybe a little bit more. So it's not a hugely liquid stock, bluntly. Most of I should have said at the beginning, but our shares are listed on in euros on both Euronext Dublin, which was formerly the Irish Stock Exchange, but also on the London Stock Exchange. So you can buy shares in either, but in reality, most of the volume goes through and they're identical, but most of the volume goes through the Irish Exchange. This is all public information, but we have a number of large shareholders. So TIA, CREF would be one of our larger shareholders, with kind of greater than just over 5%. Similarly, Bailey Gifford, Standard Life have a reasonable sized stake. Morgan Stanley Investment Management. So it's a list of largely institutional shareholders.
I think you touched on this already, but what is the status of development projects, and have future development projects been paused for now?
You mean in the market or us specifically?
I believe for you guys.
Okay, so we've actually been quite fortunate in terms of how things have worked out for us. In that, as I said, we've been pretty heavy on the development front for the last few years. At the moment, we have one 60,000 square foot office building that we are progressing, which we expect will complete later this calendar year. which is called 2 Cumberland Place. That's about so there's about 18 million of capex left to go into that project. That's the only building we have currently active at the moment, and that building is about 40% pre-let to 3M now. We are, I suppose, if we look at our future development pipeline, we could have started one project called a Marine House this year. We haven't made a final decision yet, but my guess is we're probably thinking about delaying that project just until we see how the market unfolds. Regarding beyond that, the next project would be Clanwilliam, where the tenants' lease is expiring late 2021. I guess we have optionality there in that the building is it's 1970s building. We could, if it isn't the right time, postpone that project, and seek to put new leases in place, for, at least in the short term. My guess is, unless there was a very aggressive softening of the market, we wouldn't choose to do that, because the break even on that project and also on Harcourt Square, which is our other large office development, are relatively low. You're probably talking rents in the kind of early 40s a square foot to break even, and market rents at the moment are still in the sort of late 50s to early 60s. So there would have to be a fairly large fall in rental values before those projects became unviable from our perspective.
Okay. Couple here. I think it's been a bit of a theme today on the office sector. What has been the impact of COVID on office demand from the tech sector? And another one here, similar lines. Some tech companies stating that a bigger proportion of their workers will work from home permanently. What impact will this have on demand from the tech companies?
Yeah, it's a good question. I think the honest answer is it's probably too early to see from the statistics. So it's more what do I think, as opposed to what can I tell you from empirical data. What we do know is that there is at least one big tech firm that is still seeking to. I mentioned earlier there are a number of large letting deals that are still out there that we expect are likely to complete in the coming months, and one of those is a large tech firm. So it doesn't seem as if they have altered their plans to continue expanding. I guess when we talk to our own tenants, they which a good number are tech companies, as I mentioned before. I think they're still most of them are wrestling with the first order issue, which is how do I get any staff back to the office in a socially distanced world when there's a 2 meter protocol. 2 meter is a safe distance. How do I work that out, more than thinking about and I think that's at what time will they come back, and how does that interact with the government guidelines in Ireland, etc. So I think that's more their immediate focus. My personal view in the longer term is that I think working from home is probably going to become a bigger part of work. What I think one could already see that trend starting even pre-COVID. No doubt that's being accelerated by what's going on, and people have found that they can work from home. But at the same time, I think it benefits some people more than others, and a lot of the staff that are employed by the tech firms in Dublin are relatively young, in their 20s, and they're probably the cohort that least likes working from home for all sorts of reasons. They're probably sharing a flat, we haven't touched on this too much, but there is a serious lack of rental stock in Dublin. There's a serious housing shortage, so they're almost certainly sharing. But it's also much harder to do training if you're not in the office. So I suspect that the impact on the tech firms, whatever they say, whatever Facebook and others say in the sort of headlines, it is going to be much less than one thinks, because I just don't think that their staff, particularly the younger ones, want to work that way.
Yeah. Cool. Can you say something about how your rents are likely to perform when inflation returns?
I suppose none of our, or I think almost none of our leases have inflation-linked clauses in them. The way it tends to work is we have 5-yearly rent reviews, which these days it's another change that's happened in the property market since the financial crisis, where we now have we have upward and downward rent reviews. So generally, what happens every 5 years, there'll be a rent review clause. The rents will be marked to market for that building at that time. I suppose so. That means on a 5-yearly basis, we have no protection from inflation. But in theory, on a rent review clause, if there has been substantial inflation, one would expect that that would be reflected in the sort of market rents at that point in time. So even though it would be lagged, I would expect that we would catch up with any inflation, all things being equal. But of course, the property market is inherently cyclical, so there will be other forces at work, as well as just supply demand forces that will likely have an impact on rents as much or probably more than inflation itself.
Yeah. Okay. Cool. Question here: why would I buy your REIT rather than another? What makes you distinctive?
I think if you want where does Dublin sit? What's the opportunity for Dublin as a whole? It's in a I think there's an opportunity, and I don't particularly like using the Brexit word, but I think Dublin stands to be a winner from Brexit, because if you want to be in an English-speaking country that's within the EU, Dublin is really one of your few opportunity places to go. As I mentioned earlier, we think we've seen less. There've been a few financial services firms who've moved some staff over, but for the majority, I think, has been seen in the tech sector, where there's been a very substantial amount of take up from the tech guys in the last 2 or 3 years, probably more than anyone expected. And in my view, that's what we might call a kind of a latent Brexit move, where they were looking at where to relocate their staff or where to put the investment to work. Would they put it to work in London, or would they put it to work in Dublin? I think that the uncertainty around visa controls or otherwise in the UK has meant that there's probably been they've tended to come down the side of Dublin. So I think if we're heading towards, and who knows whether this will or won't be the case, but from what seems in the papers at the moment, there seems to be a distinct possibility that there will be a kind of a no deal scenario. And in that situation, I think Dublin may well benefit from that situation in terms of office demand, or in terms of tenant demand. More generally, I suppose it's not really for me to comment on the Hibernia share price, but what I would say is that currently we are trading at somewhere close to a 40% discount to net asset value. So it's up to you to make your own decision on whether that's represents good or bad value. But I think definitely it's towards the wider end of the discount range versus some of our office peers in other markets. And secondly, our leverage is one of the lowest in the REIT sector, as I mentioned. So there's very little financial risk. It's up to you to judge the risk attached to the shares, I guess.
Just you talking about there about companies moving over perhaps because of Brexit, stuff like that. Is there any statistics on how many companies have moved or decided to move to Dublin rather than, or from London, or rather than London?
I think it's hard. There have been some statistics about how Dublin has performed in terms of number of moves versus, say, Frankfurt and Paris and Luxembourg. And generally, if you look, I don't have them at my fingertips at the moment, I can probably dig them out. If you look, generally, Dublin has, at least in terms of number of moves, has come out pretty successfully, or number of companies that have said they're looking at Dublin as opposed to the other cities. It has come out. It's come out towards the top of the number, which, given the size of Dublin, is a pretty good performance. In terms of, I think it's very hard to quantify, Richard, people choosing Dublin versus, if they're looking, if you're a US tech firm trying to think about where you invest. It's been very hard to effectively to determine that they have actually chosen, Dublin rather than London, because no one's going to say that to you. But I mean, I think I suppose the take-up statistics themselves kind of show a picture. We've seen extremely strong take-up over the last 2 or 3 years, certainly since 2016, and particularly from the tech space. And I don't think all of that has been driven just by Dublin itself. I think there have been external factors. I also think, by the way, that interestingly, no one ever thought this, but would be the case. But the other thing, on the one side, you've got, if you're looking for an English-speaking country, if you're a US tech firm, on the one side, you've got the uncertainty created by Brexit. On the other side, you've actually had the sort of issues that that Trump has been creating for getting skilled staff into the US. So I think that's another reason it's probably pushed more tech firms to Dublin.
Question here on Green REIT. How has the sale of Green REIT affected Hibernia?
How has Green REIT affected Hibernia? So I guess for those who don't know, Green REIT was a similar REIT to ours that was that sold it or put itself up for sale last year. I suppose there have been and successfully did sell itself. I guess probably I mean, we weren't pleased that I mean, good luck to them. They got out at a good price and they did a good job for their shareholders. So in that sense, we're happy for them. I suppose we thought that actually having we didn't really see Green as a competitor, and I'm not saying that in an arrogant way, but we had different strategies, and we weren't really tripping over each other in terms of the Dublin market. And I think from a listed perspective, it was good to have them there. We were on slightly different reporting cycles, so generally one of the management teams was on the road, and I think it was they did a good job of raising the profile of Ireland. So we're sorry to see them go from that sense, and we're also sorry to see them go from the point of view of it just means there's one less REIT in Ireland, which just makes the country probably less meaningful to your average international investor. I suppose there was a whether it was directly related to Green's move or not, the government did change some of the tax rules around REITs after or actually during the Green sales process, which may have happened anyway. I don't know, but certainly that wasn't, and I can expand on that if you'd like, but that wasn't particularly helpful from a sentiment perspective. So to the extent that was caused by Green's move, clearly that hasn't been very helpful for us. They didn't escape that themselves, by the way. But just that's I suppose what I say on the matter.
Okay, I think we've run out of time now, but thank you, Thomas, for your time and the presentation and answering the questions. That was really interesting. Thank you.
Not at all. Thanks very much.
Have a good day.
Thanks all. Thanks. Bye.
Okay. Next up, we have Bronwyn Corbett, the Chief Executive of Grit Real Estate Income. I will just get her online now.
Hi, can you hear me?
Hi, Bronwyn. Yes. How are you?
Fine, thanks, and you, Richard?
Right. Yeah, I'm good, thank you. Yeah, thanks for your time today. I'll hand it over to you.
Perfect, thank you. So my name is Bronwyn Corbett. I am the CEO of Grit Real Estate Income Group. And I'll just be updating the participants today around who our company is, what we've been doing, the impacts of COVID, what we've been seeing across the African continent. So just to go straight into the presentation, Grit was a company that was co-founded 6 years ago. That was really around the basis of investing in real estate across the African continent, not in South Africa itself. And the investment strategy was very clear from day one and continues to be very clear as we are currently navigating some of the challenges of COVID. So the investment strategy was to invest across multiple geographies across Africa. We are now invested in 8 different jurisdictions, to invest in a multiple of asset classes. And we have a very diverse portfolio, which has proven to be very resilient over some very challenging economic times. And then really just focusing on supporting corporates and global real estate guys or global tenants with their real estate needs. So our portfolio is predominantly let to global tenants. So just from the perspective of really just understanding what the Grit business does, it really is a business very unique. There's no other business that has a multi-geography real estate platform across Africa. Again, for me, the African platform is sort of the last frontier of growth. And, you know, being able to service some of the multi-global tenants across Africa and also tenants that are quite sticky to the macros of some of these countries is quite important. And we've seen that and we continue to demonstrate that. So I just wanted to just go through the next slide. Just give me a second. There we go. Sorry. I'm just quickly clicking into it. So really, if I can take you on to really what Grit is all about, and I'm just going to skip over these few slides. If you just give me a second. Okay, if I can just go to the next slide. Thank you. So if you look at this, as I've mentioned, we are currently invested across the African continent. We are a distribution business that focuses on both distribution and net asset value growth of across the real estate portfolio across Africa. And really, we are completely focused on Africa. And what the intention is that we look at why the African opportunity, you know, the investment into, as I've mentioned earlier, what we see as the last frontier, where we see the population growth, where we see the economic growth, where we see real estate that is really just at the beginning of development. This for us is the huge opportunity. And if I can just ask you to go through to the next slide. You know, the basis of the Grit investment case is really around Africa. As I've mentioned, we are invested into North Africa. We invested into West Africa, East Africa, and SADC. Our portfolio sits at just over $900 million worth of assets. As I've mentioned, we have a cross-diverse portfolio. Half of our Grit investment world is into investment grade Africa. These are countries like Morocco, Botswana, and Mauritius. The other half is into what we classify as growth Africa. The important aspect is that we have to remember that there are 54 countries in Africa. And, you know, the big perception is to ensure that Africa isn't tainted with the same brush. So our investments into these jurisdictions, what is very important is that there are certain very key aspects like the macros, the ability to move money in and out of these countries, the ability to have management teams on the ground in these particular jurisdictions. We have over 100 staff that are based across these platforms that service property management, facilities management, and really the entire real estate platform across Africa. And the basis of that is that we're wanting investors to be able to access Africa, but to use a platform like Grit, which is a multiple listed platform. We are listed in London on the main board, that has all the governance structures that have already been put into place, but still has the ability to access the exceptional growth and what we see from a return basis in Africa. So if you look at our portfolio itself, It is split across those 8 countries. If you look at the sectorial split, we have access into a diversified portfolio, which is sort of categories like offices, corporate accommodation, light industrial, retail, hospitality. Interesting enough, sort of the life of COVID at the moment is that we haven't seen as much significant retraction on our retail as some of the more established markets have seen, and that is because our retail is convenience retail. It's focusing on mass market type shopping. The other sort of exceptional quality of Grit is that we've been able to predominantly access hard currency leases. So we collect in euros and dollars, we fund in the same currencies, and the collection of these hard currencies are with tenants, global footprint tenants that are able to actually secure hard currency leases. And at the end of the day, we distribute out a dividend every 6 months. And that distribution is obviously focused on ensuring that there is adequate cash flow, collection of rentals, and then also focusing on the NAV growth of the business. So if I ask you to just go on to the next slide. This is really around what I call the sort of the group strategy, the focus of what makes Grit a success where others have really not had such an easy time on the African continent. And if you look to the left of this, again, you'll hear me talking about counterparty, the strength of the tenant, quality. So 70% of our revenue is made up of 15 tenants. Those are global international tenants, tenants like the American Embassy, Anadarko, Vale, some of the big financial institutions. Again, the diversification story, not having all the eggs in one basket, so being able to invest into different countries that are driven by different macros, North, West, East, and static Africa. And then also the ability to secure hard currency leases. So even though you might see local currency fluctuation, Grit is not exposed to these local currency fluctuations. So we invest in countries where we are actually receipting and collecting euros and dollars, and then the ability to move those out and distribute through to our tenants. So if I can just ask you to move into the next slide. So again, you know, the platform of Grit as it stands today, as I've mentioned, we sit with an asset base of just over $900 million. You'll see the countries of investment. The business is actually domiciled and based out of Mauritius itself. We sit with 2 very large hospitality groups with regards to Lux and Beachcomber. The benefit of sitting with these 2 hospitality groups versus many others amidst the COVID and what's going on is the fact that both these groups are the largest employer of staff across the island of Mauritius, and both of them have had huge support from government. So they continue to service their obligations from a real estate perspective. So, and again, you'll see some of the bigger brands. So we've had no impact on office. We've had no impact on corporate accommodation, on light industrial. And even in some of these countries, they have not had a hard lockdown. You know, the Ghanaian president actually made a great statement whereby he said, if I send my people to work, I possibly will kill them. If I keep them at home, I will kill them as well. So the reality around that is that Africa, which is an emerging market, some of the countries like Ghana, like Kenya, like countries like Mozambique have not considered the hard sort of lockdown as what has happened in the balance of the world. So businesses operated and continued as usual in some of these jurisdictions. I can just ask you to pop to the next slide. So as I mentioned earlier, sort of close on 70% of Grit's revenue today sits and supported by 15 global tenants. The other important thing is not just the multi-geography, but the multiple industrial allocation. So what industry are they sitting in? So, you know, we had seen a lot of our peers go off into likes of Ghana, likes of Nigeria, whereby it was very much on the oil and gas type focus. You'll see that our portfolio is very diversified. So we have a range of industries. Where we see the future going for the African continent is we see a lot more focus on light industrial. We see a lot more focus on offices and the ability just to service some of the big telecoms companies across Africa, which some of them sit as clients today. I'll just ask you to pop through. So the benefit of the Grit team, and obviously that we have founded the business and started the business from the beginning, really 6 years ago, around $130 million, now sitting over 900. what the value add and how we add value as a management team is we have the ability to really sort of take an opportunity in Africa and possibly redevelop that particular asset, as we did with Anfa and Casablanca, but also roll it into the creation of sophisticated markets going forward. So Morocco has just promulgated REITs and the ability to now have one of the most substantial assets in Morocco to roll into a REIT. The benefit to investors is the yield compression, is the ability to extract more value out of that. Something like the Vale housing estate, whereby we completed a further phase 2 and 3, and we saw substantial growth on the net asset value itself. Commodity House, which houses ExxonMobil, we were involved in the development of phase 1 and phase 2. What's very important, however, is that Grit itself, the company, the listed vehicle, does not take development risk. So we will look at pre-funding into transactions whereby tenants are secured, whereby developers are secured. What is important for us is that we have a almost fully occupied portfolio to global tenants, allowing international sort of developed market investors to access these type of global guys, whereby they wouldn't necessarily be able to access them in markets that are a lot more developed, things like in Europe. So something like Vale Housing Estate houses Vale, as I've mentioned, Commodity House houses ExxonMobil. I can just ask you to go to the next page of the presentation. One of the big selling points of Grit has been the dividend and also the performance of our dividend yield to our peers. Again, you know, it's been trying to educate the market around, yes, we're in Africa, yes, we're in jurisdictions that might not be understood, but we have a very hands-on, very personally invested management team who owns quite significant shareholding in the business that is very aligned to delivery of this platform. So the dividend yield has been tremendously good and continues to be benchmarked quite highly if you put that against our peers. We were one of the few companies that actually paid out a distribution amidst what happened amongst COVID. We have put out guidance around what distribution is going to look like going forward. And we are intending on paying some form of distribution provided our collections are adequate. So even though that things are difficult at the moment and places like Mauritius have seen an impact on tourism, the strength of the tenants have been absolutely key to ensuring the success and making sure that we secure the revenue stream going forward. So if you can just go through, Richard, to the next slide, please. So the evolution of the NAV and where we have come now to where we are from an income producing asset base of just over $860 million is that we have really, as you see, have seen significant growth. You might have heard me mention at the beginning of the presentation that the real estate opportunity in Africa, it's not even the tip of the iceberg to what we are now. So the identification of pipeline and securing pipeline for a business of our nature that's really had first mover advantage is quite key. And it gives us a formidable start to some of our peers across the African continent. So not only do we sit with the pipeline today is over 860, but we also the existing portfolio at 860, we sit with a healthy pipeline of just over $250 million. And that is really around further diversification into the countries that you see investment today, the ability to ensure that we deliver on the dividend and the net asset value growth of the business, ensuring that we actually obviously are expanding across certain sectors that we see huge growth in Africa, things like light industrial. We've seen office space still having a huge trajectory across Africa because it isn't developed as yet. Richard, if I can just ask you to pop to the next slide. As it stands today, you will see that from our shareholding structure, so we have originally sat with 3 listings across the Johannesburg Stock Exchange, the Mauritius Stock Exchange, and London Stock Exchange. We're in the process and are almost closed the delisting of the JSE. So the capital structure will be a main board listing in London and a secondary listing in Mauritius. Traditionally, all the African pension funds that invest in Grit sit in Mauritius. We've got just over probably about 50% of our stock that is held by pension fund money. They like the investment case because it's long-term leases. There is growth on our leases in dollars and euros that we see annually still. It's low vacancies. The lease expiry profile is relatively long, and the ability to access tenants like the embassies, et cetera, as I've mentioned before. We listed in London on the 31st of July 2018. The first business of our nature, which has been quite interesting. We pioneered the first Mauritian business to list in London. We've seen growth in the share register from 12% to just under 30% of the London register. You'll see sort of the third largest investor in Grit today is M&G. You'll see the likes of Rafa, and these are income guys that have looked at Grit as an alternative investment, number one, but secondly, the ability to still extrapolate growth out of markets that are actually battling with growth at the moment, and to still pay a very good dividend yield and still see net asset value growth on the portfolio itself. So if I can just ask you, Richard, just to pop to the next slide. So if you can just go down to the next one. So I think what's at the top of everybody's mind is just the management of COVID. You know, the benefits of being multi-geography, but there are also obviously disadvantages. Benefits of the fact that each of these countries have handled COVID, some extremely well, some not as well as others. But what we've seen generally outside of South Africa, from the African continent, and some of the leaders, is that they've taken a view that from an economic perspective, most of these countries can't fully shut down. And what we've seen out of that is that, yes, we've seen an increase of cases, but not necessarily an increase in deaths. And there's all sorts of debate about the African continent and what that means. It's not an aging population. It's dealt with disease historically. If you look at some of the stats around some things like Ebola, things like TB. However, the multi-geography footprint has stood us in really good stead and made us very resilient. I never thought that we would be discussing the resilience in relation to a virus, but it has made us resilient. And as you see, our countries of investment, who have all acted and behaved very differently. Mauritius itself is an interesting dimension or dynamic to the African continent. We have sat with close on probably about 70 days being COVID-free. So it will be interesting to understand how they will be reopening their borders. But what is very important is the magnitude of government support that has come for some of the local operators in Mauritius. And we obviously house two of those major operators, being Beachcomb and Lux. So Richard, if I can just ask you to pop through to the next slide. So the actual impact on the Grit's portfolio, and as you can see, the African continent on the left, corporate accommodation, industrial and office that we have seen relatively little impact to, sits on about 48% of our portfolio. The hospitality portfolio in Mauritius sits at 19%. And basically, rentals have been postponed by legislation until September, but those tenants have been given government support to continue to service rentals. And then the retail sector sits at about 32% of the portfolio. So Zambia itself, all-driven convenience, has seen probably little impact. It's seen some impact, but little impact in relation to any major shutdown. Morocco itself, because it's been closely linked to Europe, has seen probably the largest impact in our portfolio. But Morocco has opened now, and we're actually seeing some very good particular shopping center. Thanks, Richard. So from our side, you know, one of the big things really around, and I've sort of classified the reinvention revolution of what the world is going through and what we need to is Grit. I think for us, the management team, who's been grounded for some time, has done an exceptional job, one, dealing with financiers, extending facilities, ensuring further liquidity facilities are sourced. Some of the major impacts is that we've done a big overhaul of the business and have seen on our admin cost line about a $3 million saving. We have taken some salary cuts from a senior management perspective, and really just had a look at the rental collection side. And we're probably close on track on 80% rental collection, which again far exceeds some of our peers in the real estate market. So to benchmark a Grit story against a real estate stock in the UK is a very, very different story. And it's been quite important for us to have a narrative that differentiates what Grit is, and that why we haven't seen as much impact and why we continue to have paid a distribution and to look at paying a distribution going into the future. Richard, if I can just ask you to move to the next slide. If I can just ask you just to jump onto, sorry. Richard, is it jumping onto another slide?
Hi, yeah, there must be a delay. I'm on the robust business approach slide.
Okay, is there a conclusion slide at the end?
Nope.
No, sorry, just if you can just go, sorry, it actually is delaying. So you're going to have to go back. If you can just leave it on here for a moment, and then I'll just ask you to skip 2 slides, Richard, after I've gone through this. So I think, again, just to provide a bit of a summary, really around the Grit investment case. So what we have is we have exceptionally good people across the African continent. As I've mentioned, over 100 staff are based across Africa. We are able to control the real estate cycle from start to finish. So all of the property services side of the business, we have secured multi-global tenants into these regions. We sit with low vacancy and long-term leases across all of these platforms. The importance of relationships in our business, not only from our tenants themselves, but our financiers, as we've seen in the midst of COVID, and the access to liquidity facilities, also the access to pipeline, and the access to partners across Africa. And we've seen that even coming more imperative as people are trying to find some form of liquidity for themselves. So we see a huge amount of opportunities. And then really around understanding the risk mitigants. So how do we as a management team mitigate the African risk story? So collection in hard currencies, euros and dollars. We have political risk insurance across the African continent, which secures the movement of money in and out of these countries. So we are able to insure against that, ensuring that we will only invest in countries that we are able to fulfill margins of safety, things like political stability, land ownership, the ability to move money, the ability to secure debt in those countries. 54 countries in Africa, Grit only invests in 8 countries ex-South Africa. So it's very important that there are countries that we will not invest in. You will not see us in countries like DRC, and in countries like Angola. The risk profile does not work from the basis of investment on our real estate type platform. And then the proven ability to raise capital for Africa. So as you can imagine, that hasn't been an easy task, debt and equity. And we've raised a substantial amount of capital over the last couple of years. And again, it's really just being able to deliver on distribution, deliver on targets, deliver on what we have said to the market, which is quite important. So I think just to summarize, and Richard, if I can ask you to go the next slide and then just skip one more, please. So for us, I think, some of the near-term objectives, we've tried to lift our heads out of this sort of COVID pandemic that we've seen. A lot of businesses have tended to sort of go into hiding. We've ensured that we've continued to manage continue to manage collections, which is paramount, continue to give our tenants solutions. A lot of our tenants themselves were quite panicked to what they saw and what they see in the market. So we've come up with some really eloquent asset management solutions. But for us, it's really now saying we've stabilized the business, and whether we see a next sort of wave in COVID, we believe that we've sufficiently stabilized the business to endure what is to come and a little bit of this uncertainty. We've seen very, very good pipeline and the ability to secure pipeline with strong partners, and we want to be able to look at converting that. So the growth story of Grit still continues, and if anything is more relevant today, we are currently looking at a standard step up from a standard listing in London to a premium. The delisting, as I speak, is currently being closed, and that we will no longer be trading by the end of the month from the JSE. So we've cleaned up the capital structure. And as I've mentioned, the ability now to roll into capital market structures in some of these regions. So not only do we have an asset, but we're able to look at the REIT markets and being able to see yield compression for our investors at the end of the day. So Richard, I'm going to end on that. And then obviously we will take any questions.
Great, thank you, Bronwyn. Yeah, sorry about I think we were having a bit of a delay on the
no, it's fine.
on the slides, but yeah, quite a few questions coming in now. In light of the apparent increase in land repossession actions of South African governments, how can investors be comfortable that the same fate will not afflict commercial property owners?
Yeah, so it's an interesting one. I've always had I come out of a South African company, real estate company, which I co-founded a couple of years back. And one of the reasons for leaving South Africa was because of some of the major economic challenges that we see. And political is a very large one. So, and again, I mentioned earlier, you have to be so careful with tainting Africa with the same brush. And obviously what we see happening in South Africa now is of grave concern, because South Africa has always been seen as the anchor of the African continent, and to an extent, Morocco from a North African perspective. So the challenge is that, people see what's happening in South Africa and they're worried it's going to happen elsewhere. My learnings in the jurisdictions that I operate today and what my team has, and I mean, amidst all of us that work here, we've been across the African continent for probably over 15 years now, is that the rationale for investing in the countries we do today is because that we do see a lot more stability, and we see stability that's been proven in things like land ownership. So, the importance of land ownership for a real estate business is key. And we actually turned away a couple of years ago an opportunity in Tanzania because of exactly that same thing. So land ownership is very high risk in countries like Nigeria and Tanzania, and land being taken away and under land claim. And we just won't invest in countries of that nature. So the sophistication of title, the sophistication of South Africa, even though unfortunately South Africa isn't as the benchmark. South Africa is going through its own challenges from a political perspective, and that's a lot of that political drive is what's underlying some of the more unusual things that you're seeing happening in South Africa itself.
Great. What sectors or industries do you see having the most growth potential, i.e. telecoms or banking across Africa?
So for us, our sort of future of Grit and where we see and where our pipeline is driven is we see lots of focus around light industrial. The ability to distribute out the involvement in pharmaceutical warehousing, all of that. Grit actually has investment into that today, and the expansion of that and the resilience of that asset class being light industrial has been quite amazing to see. So we see a lot of opportunity in light industrial. We continue to see a lot of opportunity in corporate accommodation that comes around the embassies. Embassies like the American embassy are generally very sticky to some of these countries. So you wouldn't see an exit from them when you are seeing macro challenges. So from an office accommodation and accommodating your staff, so we see growth in that. We also actually, interesting enough, see growth in medical. So there are a lot of operators that have traditionally owned their own real estate that are wanting to expand because of where we find ourselves. So we see opportunity around the actual real estate itself around medical. So for us, we have tended to stay away from retail. Retail continues to be a struggling asset class. The convenience retail will always have a place across Africa, but the super regional type retail, which we are not involved in, we don't see necessarily having a place. But for us, the focus of Grit really is around that light industrial, supporting offices, some healthcare type opportunities coming out of there. So that is really where we see the growth. And again, the tenants that we see have been the most resilient have been the telecommunications companies. So Vodafone, we own the largest Vodafone office in East Africa through our Mozambican office. So the telecommunications companies, we're seeing huge opportunity. Guys that are carrying, major sort of warehousing in relation to that, major data centers in relation to that. Financial services continues to also be resilient, but you have to be very careful because a lot of financial services companies have tended to be overexposed to real estate themselves on many branches, et cetera, et cetera. So, for example, we own the ABSA head office in Mauritius itself. So that's where we see the opportunity being aligned with head office type opportunities from an office accommodation perspective. So, and then again, linked to telecommunications are the IT companies. We're looking at warehousing that's supplying the largest supplier of sanitary ware and sanitary products and products across East Africa, warehousing to support those. So again, we are very focused on the tenant, and whatever the tenant's real estate need is, we're happy to then go along them with that real estate need, provided the tenant makes sense. Mozambique is a great case study. I mean, we've owned our portfolio there for 6 years, literally through macro hell, and IMF withdrawal and tuna boat debacle and scandals and all sorts of things. But we have had the best performing portfolio in Mozambique because it's been Anadarko, it's been American Embassy, it's been Vale, it's been APSA, it's been Hollard Insurance, it's been the auditing firms. And again, those guys have existed even through macro hell. So even though we've seen challenges with delayed timing of moving payments, just general regulatory challenges, we haven't seen challenges with our tenants themselves. And that is the importance to have an extremely sticky tenant, that if the macros do turn on you, you have the ability to have the tenant with you. Not only the tenant, but the local pension fund invested in Grit itself is also important. So National Pension Fund of Mauritius owns 5% of Grit. We've got the Seychelles Pension Fund. We've got the Botswanan Pension Fund. We have Eskom Pension Fund. Because as you can imagine, that if things do get to a point where they are quite tricky, if you march in with the local pension fund who's a shareholder in Grit, it makes the ability to sort of deal with the regulators on a much easier basis. So the pension fund money is also very, very good money to be invested at Grit level.
Great, thanks. Question here, do you target specific countries and or any off limits? I think you answered that one in your presentation.
Yeah, so I think just to maybe sum up that quickly, I mean, we invested in 8 countries. As I've said, we want half of the world invested into investment grade Africa. And I always have to remind people there's such a thing as investment grade Africa. You know, countries like Morocco, Botswana, and Mauritius. The other half is growth Africa, but there are loads of exclusions. I mean, as I keep on saying, there are 54 countries in Africa. So, you know, there are just some countries, and I mentioned them earlier, the DRCs, the Angolas, even Nigeria. People are surprised that we're not in Nigeria, but I always say there are a lot of Nigerians with a lot of money, a lot of dollars that do real estate themselves that we don't even want to compete with. They do a much better job than we could do in Nigeria. So for us, you know, the actual specific countries are very, very important. And we have 8 countries today. So the basis is now it's about being able to leverage off the platforms grown and to be able to continue to invest in the countries that you see today.
Right. Can you say something about the influence, if any, of Chinese investment in Africa? Is this influence in the sectors, countries which you choose to invest?
Yeah, so I think, you know, interesting enough, Bank of China is one of our largest financiers from a debt perspective. And we see them, you know, a lot more resilient to some of the other financiers. So, you know, you often find financiers sort of fall in and out of love of African countries, where Bank of China is a lot more resilient because of their Chinese counterparts that found themselves, and obviously big client bases that found themselves. So for me, you know, the Chinese have invested where others have feared to go. I think that it will be extremely beneficial for them. They've got huge investment into Mozambique. There's some large Chinese companies invested into some of the gas initiatives that you're seeing coming out. So for us, you know, where other people haven't wanted to invest in infrastructure, the Chinese have come and invested. And you can like this or not, but the importance of Chinese investment and what we've seen it do across Africa, actually including Mauritius itself, if I look at the infrastructure of roads and what they've done here, has actually been quite paramount to the growth of some of these countries.
Yeah, cool. What should we move on to next? Question here asking you to repeat the detail on the leverage and debt exposure.
Yeah, so we have our entire portfolio gets independently valued on an annual basis, and that's done by valuers out of the UK, which is quite important, and it's one of our LSE requirements. So we have predominantly wanted to achieve a just below 40% LTV, loan to value. Debt in our lives is slightly different to what you might see in an established REIT. So one, it is we don't see as much valuation fluctuation as you might see in developed markets because the underlying growth continues and our leases continue to grow. So the growth of our portfolio is quite consistent. We can also use leverage effectively to enhance returns. We are borrowing at effectively in euros and dollars just under 6%. You know, if you're buying at sort of yields of 19% and borrowing at 6%, it makes absolute sense. We have seen LTV track up sort of in the midst of COVID. That has really been driven by the access to liquidity facilities that we've driven through the business. We've had to support some of our larger hospitality tenants amidst some of the timing and getting their government aid and supporting. So we've seen that, but ideally our sort of sweet spot sits between post, once we get through all of this, about 35 to 40%, but we do see that tracking closer to 50% whilst we've done these quite conservative valuations. So the valuers have been hellishly conservative for our financial year. And this has been based on obviously the uncertainty, what they see. So we're quite comfortable with what you see from a valuations perspective, and we're quite comfortable from a headroom perspective and covenant perspective and liquidity perspective in the group.
How does your income perform in times of higher inflation?
Yeah, so I mean, it is an interesting question. So high inflation predominantly impacts our retail guys. You know, so where there's high inflation, and that's why we've tended in the pipeline to stay away from retail. So even though we're securing hard currency leases in these jurisdictions, we're finding in high inflation that these guys, their spending power is struggling. We have gone involved in more the convenience type retail, which I always say is sophisticated shared, because the cost of occupation for these guys is much lower. So you have a food anchor called ShopRite in one of our centers in Zambia that's got a through rental of around $10 a square meter. They're sitting in a super regional shopping center in Nigeria, $30 a square meter. The importance of that is obviously the affordability. So we don't see high inflation necessarily impacting the balance of our portfolio. Tenants like American Embassy, Anadarko, Vale, et cetera, Barclays, financial services guys, even the hospitality guys. But we do see having some impact on retail. And as you've seen, if you extrapolate our retail portfolio at the balance of Grit, the rest of the portfolio has actually grown very successfully over the 6 years. It's our retail portfolio that we've had to really see some valuation. We've had to really look at the cost of funding or the cost of occupation for tenants. We've seen leases being renegotiated in that sector specifically, and that's really been driven by what we've seen from a macro perspective in retail. So it really is just an impact on our retail, and that's why the focus is going to be very different going forward for Grit.
Right. I think you touched on this, but it's probably worth explaining it further. How big a role will developments have in the growth of Grit?
So, you know, I think from our side, originally, you know, developments are very important in Africa. I mean, in any emerging markets, you know, you can't always control your end product and it doesn't always exist. So we've always known that. But what we wanted to do is we wanted to ensure that we had a sustainable portfolio, cash flow driven, multi-global, that we had quite a good base to continue to pay out distributions. However, if we are going to see the NAV growth that we want to see in this business, it's not going to come from a fully occupied long leg portfolio, unfortunately. So developments for us going forward will probably constitute over the medium to long term around 20% of our sort of asset value. However, it's not developments. We won't be buying land. We won't be buying opportunities where we don't see tenants and we don't have line of sight. What our intention is that Grit will be involved, and we have done it already, to successfully pre-fund developers to ensure that we end up with a product at the end, but to take out the development risk, to take out the leasing risk, to ensure that they deliver on the project. And the importance of that is that we don't want to be in the market for only private equity assets and whatever else you've seen being built across Africa. We want to be able to ensure that we know where the pipeline's coming from and ensure that the pricing of that pipeline is adequate to ensure that we enhance our returns at a Grit level.
Great. Cool. One last question, which I think I can answer, but what is the ticker? So it's in London, it's GR1T. Is that right?
Yeah, correct.
Yeah.
Correct.
There we go. I believe that's the end of the questions. So just want to thank you for your time, Bronwyn, and all the best.
Thank you. Thanks, Richard. Thanks for having us. We appreciate it. Thanks.
Cheers. Oh, bye. Right. So just leaves me to wrap this all up. If I can get to the here we go. Right, so yeah, thank you all for attending the Property Summer Conference 3rd edition. Next week is our last edition. It's for professional investors only, and there's the lineup for you there. If you want to register for that as a professional investor, you can do so on our website. I'd like to thank all of our panelists again today. Thought that was really, really interesting. Also, again, want to thank our sponsors, Schroders, Hibernia REIT, the London Investor Show, Master Investor and Mello. Just a couple of points. We've written notes on both Grit and Standard Life Investments Property Income. So we've written substantial sort of research notes on those. So head over to our website to give those a read. And it just leaves me to leave you with the legal bit, if you give that a quick read, and we look forward to speaking to you again next week. Thank you.